portfolio after that good news that Jeff just gave us. So you can see assets under management for the investments division was at just north of 170 billion as of March 31st, and that's down about 5.5 billion from the end of last quarter. The decrease, again, was due mainly to the depreciation of the NCRS portfolio as markets struggled, which was down about 4.6 billion. The other asset classes decreased as well for the same reasons, but not as materially as the NCRS portfolio did. Moving on to slide 8, snapshot of our asset allocation as of March 31st. Portfolio ended the quarter at $119.2 billion, down from about $123.8 billion at the end of December. No major changes to portfolio positioning. The growth underweight increased slightly to 8.8%, with the majority of that coming from public equity, as has been consistent for the recent past. We continue to be overweight rates and liquidity at 9.7%, with the cash portfolio comprising all of that overweight. IG fixed income is slightly below the target. The underweight to inflation sensitive and diversifiers decreased by about 0.5% in the last quarter. This was mainly due to the fact that those assets performed well. Obviously, in this high inflation environment, we would hope that our inflation sensitive portfolio would do well, and it's good to see that is one of the portfolios that has been performing strongly during this market environment. And then multi-strategy, we continue to be close to our neutral 2% weighting. Moving on to slide 9, snapshot of more recent time period. Obviously, as Jeff mentioned, April was a struggle for equity markets as well, and May hasn't been great either. So we continue to see assets declining as markets struggled. Portfolio values decreased close to $6 billion since the end of March, with the portfolio at just north of 113 billion as of about a week ago. It's roughly the same now, as markets haven't moved significantly since then. And again, no major changes to allocation since the end of the quarter, although the underweight to equity has grown some, given the markets have continued to decline. Slide 10 shows our portfolio return versus our two main benchmarks. The portfolio was down about 3.5% for the first quarter, as both equity and bond markets decreased. Equities were down more than 7%, and IG fixed income was down about 5.5% for the quarter, which is pretty unprecedented, as Jeff mentioned. The alternative asset classes continue to have strong returns, led by real estate and the inflation-sensitive portfolios. So that really helped keep the portfolio afloat. You can see the one-year return was at 4.1%, below both the implementation and the long-term policy benchmark. Taking a look at longer-term performance, portfolio has still exceeded the actuarial rate of return of 6.5% in all time periods, 3 years and over, with the exception of the 15-year, which it was slightly under that 6.5% at about 6.1%. Taking a look at Q2, as we mentioned, markets continue to struggle. To date, the S&P 500 is down close to 17% from its high. And the portfolio as a whole is down about another 5% quarter to date. So Q2 has struggled significantly, even worse than Q1 was, at least to date. And the portfolio itself is down about 8.8% calendar year to date. Slide 11, no big changes here. It's the growth of the dollar. We can continue to see that markets came in a little bit, so you can see on the tail end of that the line decreasing. But both the implementation and long-term policy benchmarks, the portfolio continues to outperform that slightly, although it's tough to see in that chart. Slide 12, this one really kind of shows how much the alternative portfolio has helped. You can see on the tail end that the green line is our alternative portfolio, and then the orange and the yellow line is our total pension plan, and then the long-term policy benchmark. And you can see really how the green line has continued to go up even as the other two have decreased. So you can really see here how much that alternatives as in aggregate has helped the portfolio as equities and bond markets have struggled pretty significantly. And you'll really be able to see that in the next chart where we look at our contribution to total return for the 1 year ending March. As I mentioned, portfolio returned 4.1% for 1 year ending March 31st. And this chart shows that in percentage terms as well as its earnings. So that 4.1% equates to about $4.8 billion of earnings for the year. What's interesting is you can see that both IG fixed income and public equity struggled for the last year, and they didn't contribute as much to the total plan return as they typically do. You can see that alternatives was really the main driver here of all of our returns for the previous year. And in fact, you can see that private equity accounted for 1.95% of the plan's 4.1% return. So 47% of the plan's return was driven solely by the very strong performance of private equity, which if you think about it, it's pretty incredible given the fact that private equity is only about 6.3% of the portfolio, and it drove almost half of the portfolio's returns for the last year. So good to see those returns continuing. They may come down slightly as we get some of the newer valuations in. We've talked about how a lot of those asset classes are quarter lag in terms of valuation. So, what we're showing in our March 31st books are really December valuations for a lot of those assets. So we could see some of that come back a little bit, but today we've seen extremely strong returns from really all the alternatives, but private equity specifically has had very, very strong returns. Moving on to the attribution slide. So this is 1 year ending March 31st. The portfolio returned 4.1% versus the benchmark return of 5.8%. So it underperformed by about 1.7% versus our implementation benchmark. And you can see on the top right there how that's split between selection effect and allocation effect. And I go through this every time. But just a reminder, selection effect is really how each asset class performed versus their underlying benchmark. Allocation effect is how we are positioned versus our policy targets at a total plan level. So you can see for the 1 year, both of those were negative. And if you drill down to the bottom of that slide, you can see really that breaking that down into the different asset classes. And it was really two main drivers here in terms of both of the underperformance. On the allocation side, the overweight to cash we had really was a drag by about 600 or 60 basis points. And on the selection effect side, the underperformance of public equity versus their benchmark for the 1 year had a pretty significant effect on the underperformance of the plan. But just to remind folks, public equity had an extremely strong run back in 2019, 2020, where they outperformed significantly. So, and you'll see on the 3 year number, they still have a positive selection effect for the 3 year. But for the 1 year, that came back a little bit, and then they did underperform the benchmark. So, looking at the 3 year, you can see similar story here. Value add of about negative 90 basis points or 0.9% versus our benchmark. But the selection effect overall was very strong here. And you can see that most asset classes had a strong selection effect. A lot of them round to 0.0, but you can see that public equity was above their benchmark for the 3 year. So even though they had a rough go of it for the last year, they were still added to the portfolio over the longer time period. The 5 year, real quick, similar story. We're pretty close to the benchmark return, underperforming by less than 20 basis points. And all of the underperformance is driven kind of by that allocation effect with the underweight to public equity and the overweight to cash. But each asset class within that had a positive selection effect, which is very good to see. Slide 17. No big changes here. You can see on the top left the rolling volatility of the portfolio. You can see that volatility did pick up pretty significantly in Q1, and we continue to see that in Q2. So you can see that blue line there on the tail end pop up a little bit to get closer to the long-term averages for the volatility. but it did decrease pretty significantly since the height of the pandemic in 2020. And similar story on the tracking error side, which is the top right here. You saw that spike up significantly during the pandemic in the first couple of quarters of 2020. But you can see that that's the 1-year number, the blue line, it's come down pretty significantly, and then the other longer term metrics have kind of flattened out. Slide 18 shows kind of the downside risk here. Nothing materially changed since last quarter. You can see that, the tail end there on the right, when the markets go down, we typically the portfolio typically protects pretty well on the downside. That wasn't as much the case in Q1 because of the fact that IG fixed income struggled along with public equity. Typically when public equity goes down, IG fixed income is flat, but typically has pretty strong returns, which really helps the portfolio. So it was a pretty unique situation in Q1, which obviously Jeff mentioned before, where that really hasn't happened before in the last 50 plus years. We're seeing a little bit of a return to normal in Q2 in terms of that, where the correlation of equities and fixed income aren't the same. And equities continue to struggle. Fixed income hasn't been doing great, but they've certainly been doing a lot better than equities in Q2. So a little bit of a return to normal. So you'll likely see, depending obviously what happens the next 5-6 weeks, you'll see this chart show that the portfolio is protecting a little bit better on the downside in Q2 at least. Slide 19, the universe comparison. You can see here that on the risk side and on the return side, we're really on the bottom decile for the last first couple of metrics, the 1 and the 3 year. I mean, this really just reflects kind of the fact that we have one of the lowest risk profiles among our peers, which has projected into one of the lower returns in this environment. And a lot of it has to do with what we just talked about. But I just want to make sure we understand. Obviously we look at what our peers are doing. We obviously want to we want to compete with how the peers are, but we'll go through our investment policy statement in a little bit and just remind folks kind of why we set that and what we do. But within our investment objectives or our investment policy statement, nowhere in it is to look like our peers or perform like our peers. We really are solely focused on kind of what this plan needs and the risk profile that this plan needs and the return profile that this plan needs, given that we aren't like our peers. Our liability structure is different, our funded status is different. So it's always good to look at these and to understand where you are, but it's not really what our objectives are. So I just want to make sure I put that in context. Moving on to the other universe. So this is the Sharpe ratio, which is really a measure of risk-adjusted return. And historically, we'll look very strong on this metric given our low risk profile. You can see kind of on the 1 year, that's not so much the case, but on the longer term time periods, you can see that we're in the top half and a lot of times in the top or close to the top quartile. Slide 21. So this is our liquidity profile. The left side shows the liquidity allocation in terms of dollars, and the right side shows it as percentages based on each asset class. This doesn't change dramatically from quarter to quarter. The main part of this slide is really the total plan. We try to set liquidity at a minimum of 70%, what we call level 1 liquidity, which is just really extremely liquid. Basically, we can get at it within T+3 or not much longer than that. And the total portfolio currently is at about 75% of level 1 liquidity. So we definitely have significant amount of liquidity in the portfolio to help meet our needs if needed. And it's well above our threshold that we set of 70%. Slide 22, benefit payments. You continue to see the benefit payments, which the solid orange line there, the benefit payments as a percentage of total plan continue to kind of decline as we've been paying out slightly less benefits on a net basis the last several years, and the assets had been growing up until recently. So you've been seeing that orange line decreasing, which is a very good thing. If we're paying less out as a percentage of assets, that obviously helps the assets grow faster over the long term. So it's a good thing to see on a net basis. It's not something we expect will continue. We do expect the net benefit payments to start to increase. So hopefully the assets can continue to exceed that, and we can not see that orange line spike up very much. But we tried to, we have a monitoring threshold of 3%. You can see it was hovered around that 3% for a number of years, but we'd seen that come down pretty significantly in the last several years. So that's a good thing to see. And it just goes to show you again kind of the strong liquidity profile that the portfolio has. Slide 23 on the alternatives liquidity. We continue to see strong net cash flows coming back from our alternatives portfolios. And you can see in the top right, we received in the prior 12 months about almost 3.4 billion in net cash flows from the alternatives portfolio as a whole. And really each asset class we've seen positive cash flows and a lot of realizations toward the end of last year. I think cash flows in general, we've seen slow down a bit this year, given the market volatility. But we still continue to see more cash coming back than we're sending out to these managers. Then the last slide I'll hit is the valuation lag profile. I mentioned it a little bit earlier with alternative assets and the performance of that, and how a lot of that is quarterly valued. But you can see the portfolio as a whole, majority of it is valued on a daily basis, or at the very least a monthly basis, where 75% of the portfolio is daily valued, and then only about 18% or so of the portfolio is valued on a quarterly basis. So you can see that, for the most part, the valuations are up to date as we go through our normal process to value the portfolio. So if no questions, I'll turn it to Jeff to finish out that deck.
Slide 25 has our asset class net of fees performance. Just kind of turning from kind of the quarterly look to that 1 year look in that column. Obviously, same kind of things we talked about really stand out. That private equity number, 35%, staggering. Non-core real estate, 20%. The inflation stuff Chris mentioned earlier, it's good to see that when you have inflation, that performing. And then we see that inflation is the diversifiers as a whole of 15%. Core real estate, 16%. So some really good returns across really the private theme there. Obviously the one that sticks out there we talked is what's going on in the fixed income market. They're at -3%. And it's really been, I touched on it earlier, if you look through March 31st, even into the second quarter, it really gets uglier on what's going on in that market. Has calmed down in May, but in April, there was really no calendar year to date through early May. There was nowhere to hide in that market. Just to give you some sample kind of numbers on it. If you own long treasuries during that time period, they were down over 20%. Long corporates down over 20%. And it's really because of how rapid the increase was in rates and also in spread. Even intermediate treasuries down double-digit numbers, 10%. So tough market for that. We talked a lot in the past about.
I think you actually should repeat that. I mean, it's so significant about the 20.
Yeah, just the fact that you think of risk-free, right? On the treasury front, and it obviously depends on where you are in the curve and your interest rate risk on it. But if you own 15 plus year U.S. treasuries as a whole, -21% through early May, calendar year to date, just a staggering number on what that is. So if there's any silver lining in that market, we talked a lot over the past really years now about this kind of future rate increase and positioning wise on that, and what kind of things we did. And in preparation for that, we were running higher cash within our core fixed income mandate. Our 90-10 split that we have between our core and our stiff book, and as part of investment fixed income, we ran that number higher. We were running our duration short if we've ever done it. So while it's a tough market there, really feel good about our positioning we had. Early look through May relative to our benchmark, if we had just been passively invested, we're going to save about 200 basis points or so off of the index, which is going to be our biggest relative return difference, even though it's negative in the history of our fixed income asset class. So feel like really good about how we positioned ourselves and did that, but the market has been really, really rough on that. Again, what we're seeing in May is things stabilizing. Credit spreads have widened out. They're starting to look a little more attractive now. We've actually seen the 10-year retrace some of that rated hit on there. So I think rates are actually, returns are I think through this morning, slightly positive for the month. So we're kind of seeing that kind of settle out a lot, which is good to see. The good news part of that really, I guess, at the end would be, we talked about before, when we have this, when rates rise, spreads rise, and the yields rise, it's bad for near-term returns, but it's also the basis for future returns in fixed income. So when we think about the expected returns for the asset class, which we're talking about 2+% for a while, now we're up pushing 3.5%, 4%. So long-term for the plan, there's some benefit for that. It's sustaining a low was not a good environment for us. So, but there's definitely a pain point in the interim getting there. So just want to give some context, given how unique that the challenges were in that market.
Put that in some context. We just issued another tranche of built-in C bonds upstairs for the DOT, and that rate was nearly double what we issued bonds at 18 months ago.
So flipping to page 26, again, when you look on the bottom far right of that, you see IG fixed and public equity down there with those negative returns together. Again, those kind of numbers together on the chart. And then obviously what sticks out is up top. We look at year to date there, it's just filled with all our private market stuff. And Chris showed you how the alternatives have done, how that's added value on the previous chart. So good story for that piece of the portfolio. On slide 27, looking at our new incremental and unfunded commitments, you can see some new activity here on the left across different asset classes there. New commitments we made since the last meeting. And then on the right, kind of where we are in unfunded commitments, give you some perspective, that number unfunded on total was a little over 5.8 billion. So pretty much in the same neighborhood, slightly up, and no big changes in the individual asset class numbers, but you see how that translates on the next page on 28, which has our historical unfunded private asset class commitments. And the blue line there is the uncalled as a percentage of total market value, 5.0%. We were like 470. So still at a really low level historically, though. You can see where the 6 billion puts us on that as well too. So that reflects a little more activity we've been involved in here. Nothing really to touch on in slide 29. It's really as far as where we were on the asset allocation history. And on slide 30, nothing new to report on exited investments since our last meeting. And then finally on slide 31, which captures our top 20 investment managers. The first two items on this thing are obviously our internal portfolios we run in fixed income and also in equity. And that number's been pretty consistent. I think we were slightly higher than it was. I think we're 53.7 total cumulative last meeting. And then at the very bottom, you can look and see collectively those 20 managers are about the same number they were last time. We were slightly higher before. Usually not any real material changes in this list. The bottom kind of bounces around with the names based on valuations. I think Brigade might have been at the bottom of the list before, and they got Campbell bumped up above it again, but pretty consistent from what you've seen in the prior meetings. That's a look at kind of where things were in the quarter, and glad to field any questions any committee members have.
Make sure my thinking is straight here. If we have individual bonds, treasuries, corporates, whatever, and they take a 20% hit due to rising interest rates, we're marking that bond to market in the portfolio, but if we hold it to maturity, we haven't lost anything.
Well, what you're going to earn yield-wise on the bond from the time you buy it, whatever the yield is until it matures, would not change if you held the bond over time.
Right.
Okay. But your mark is going to reflect what the current rates are and where you could sell it in the market on it. So depends on if it was a discount or a premium. But it does reflect what the current value of the bonds is because of what the interest rate is, what the coupons that are coming in relative to the current market.
Whereas if we own Microsoft as an equity, we don't have a maturity and it's going to be whatever it's going to be when we sell it. But we're not going to realize a loss on the fixed income unless we sell it while it's down.
Your realization is going to be if you sell the security.
Right.
For sure.
Yeah. If you hold the maturity, you're going to get, assuming it doesn't default, right?
Right.
And in that world, it's unlikely to do so. But
So to Greg's point, if we paid $100 for something, and because of accounting rules, it's now worth 95, But when it matures, it's going to be worth 100 again. Ultimately, we will realize that back.
Your maturity, what you get paid at maturity does not change based on that.
Yeah.
That is correct. But the valuation reflects where current rates are and the environment and current yields are.
Right, as it should.
I would add, thank you, Greg, for that. And I would add to that, before I got here, there were policies put in place that if we were to enter another situation like the Great Financial Crisis and something that we own gets downgraded, we're not forced to sell it. We may not be able to buy anymore, but we're not forced to sell it. And that's what happened during the Great Financial Crisis. All these pension plans had to blow all this stuff out. And, but we have guardrails inside of our portfolio that, so if something gets downgraded, we're not forced to sell it.
Yeah, the language dictates at the time of purchase. So it's ratings driven. So in our core portfolio, investment grade basis, so it has to be investment grade by at least one of the three major rating agencies. And if there's a change, then you can either hold or sell will be the options on it.
Second thing I would add, when you see Campbell Global, that's our timber portfolio. So that's not wish you were a hedge fund, but I can't believe I just said that, but that's for Ron back there, but as does he. But that's our timber portfolio. I know that you and us and obviously the team get a lot of inquiries about all kinds of things that are in the news these days, which is ESG and proxy voting and lots of buzz around BlackRock. As you can see, BlackRock is mainly an international institutional index fund manager on behalf of this pension plan. Somebody can tell me as I'm talking about how many basis points we actually pay for that. We analyzed with Greg and Rhonda and others about the possibility of bringing that in-house 3 years ago, our international index fund. And as thoughtful and smart as they are, they came to the determination that with the time zones, currency fluctuations, the taxation on buying and selling securities, and all these global markets, that there's no one who can do it better, cheaper for us than where it is, which is BlackRock. Inside that portfolio is also where our direct investments are in Russia. Meeting with Congresswoman Ross this week about trying to get an exit ramp to a runway to sue President Putin for his murderous activities because of the direct investment losses, like in the Russian oil company that sits inside of BlackRock. The other thing, lastly, on this subject is that there is move afoot. We have a loyalty to our members. We don't have a loyalty to Facebook, or we don't have a loyalty to the internet. We don't have a loyalty to all the things that are said about all this stuff all over the news. Our loyalty is to our members. And the reason I say that is that there may be an opportunity and a possibility that these folks can continue to manage this money very, very efficiently on our behalf, but we pulled our proxies from them. So they can't vote our proxies. They don't own these shares. We own these shares. So there's lots of things happening in that world where we get the benefit of the efficiency of their management, but stay out of the political stuff of all the proxy voting that's been such a subject of news. Thumbs up from the attorney. So I just thank you for letting me explore that, and I just wanted to draw that to your attention. Questions?
Hey,
Questions?
this is John Anarella. Jeff,
Hey,
what's your average maturity in the fixed income portfolio? And then I also noticed that the cash balance went up. I think it was about $2.5 billion. Is that an increase due to ARPA funding and or tax receipts?
I'm going to answer your question a little bit differently on the maturity stuff. I would offer up the duration. It's probably a better representation of the interest rate sensitivity. The duration on the core piece is 7.4, IG is less than 1. So in total, our investment grade fixed income is about 6.5. To give you some perspective on that, our core benchmark's over 9, and the ag is about 6.5. We're about where the ag is, even though we managed to a longer duration target.
And then your question about cash, I think the increase was just due to flows that came in essentially from mainly our alternative asset classes. There was no direct movements or repositioning of the portfolio. It was just a function of cash flows.
Okay.
And
Thank you.
John, this is a treasure. I'd add to that I should be able to do this on the tip of my tongue, but there's about, especially in Craig's group, there were about 3 different inflows, large inflows of cash that came in from investments that crystallized. The Cosmopolitan through Blackstone sell that hotel in Las Vegas is yet.
Troy. That real estate, that would be Troy.
Oh, it's okay.
Still,
That's right. I'm sorry.
Yeah, it's alternatives. That's alternatives.
It's alternatives.
Yeah.
Apologize. So anyway, there's about a handful of big investments in the alternatives space that crystallized, that resulted in the increase in the cash balance. And we have not liquidated or sold anything. As a matter of fact, Jason and others help. We are signing commitments to take advantage of some of the buying opportunities we're seeing.
Mr. Anarell, this is Jeff again. I'll be glad to get you that number. I didn't want to bypass your question. I just thought the others might be more meaningful. We really look at that duration more than we do the average maturity, but I'll be glad to get that for you.
I think given your question, John, I think it's safe to say that we have, coming into this, we had some of the highest cash balances in the history of the plan and some of the shortest duration on the bond portfolio in the history of the plan. Which were the only 2 places to hide. There's only 2 places to hide.
And I congratulate you both for doing that. Thank you.
Thank you. Other questions? So, where are we now?
Investment policy statement review.
Okay. We're now at the investment policy statement review. Exactly on time.
I know, with that.
So, unlike me this morning, but I wasn't loafing. Thank you, Ted, for sitting in. We'll go right into that.
Great. Thank you, Treasurer. So yeah, so the next agenda item is the investment policy statement review. This is something that we do periodically with the IAC, and this is kind of the culmination of the asset liability study that we went through the last 2 meetings with Callan helping us out with that, and just reviewing the policy as a whole. So the latest version of the IPS is located in the appendix of this section, so the board members have that. But I'll just be walking through the slide deck to provide an overview of the IPS as a whole, as well as note any changes made from the previous version. As we went through that asset liability study, you will see some changes here. So just to kind of level set what the investment policy statement does. So it sets out the long-term objectives and guidelines for the investments division, specifically as it relates to the NCRS portfolio. And it really provides a roadmap for how we administer the investment program as a whole. So on slide 2, I kind of noted the noteworthy changes from the previous investment policy statement, and we'll go into more detail a little bit later on some of these. So we updated the strategic asset allocation targets and policy ranges based on the outcome of the asset liability study that you were all involved with. We updated the projected ranges of investment returns based on both the updated strategic asset allocation as well as the revised capital market assumptions that we set through that process. We updated some of the sub-asset class targets and ranges within certain asset classes to be more in line with current practice as well as our long-term objectives. And some examples of that was we changed our public equity targets to remove the 7% target to hedged equity. We still have that in there as an option, but we no longer have a target of 7% to hedged equity. In private equity, we tweaked the target allocation to both our bio and our growth strategies. Within non-core real estate, we adjusted the targets to both the opportunistic and value add strategies. And then within inflation sensitive, we removed the target to commodities, an explicit target to the real assets and other asset type that we have. And again, these changes were made to be more in line with how we're currently operating as well. And they were taken into account when we performed the asset liability study. So when we did the modeling there, that all of this was taken. And the other thing we changed, other changes you'll see is that we added language in the policy that was recommended in the governance review. As you recall, we had Aon do a governance review that concluded, I guess, the first quarter of last year. And as part of that review, they had a number of recommendations for us to implement. And some of that was just adding language within within certain policies, including the investment policy statement. So some of the things we tweaked there was being more explicit with some of the roles and responsibilities, adding a specific time frame for reviewing our benchmarks, being a little bit more clear with some of the monitoring and reporting requirements, as well as just being more explicit with some of the governance aspects of it. So you'll see those in the policy as well. Moving on to slide 3. So this lays out the investment objectives as set forth in the policy, and this is kind of what I was mentioning earlier. You know, these are 6 main objectives that we have for NCRS and in managing NCRS, and these are really what we focus on and make sure we try to achieve over the long term, right? First one is provide sufficient investment returns to ensure timely payment of statutory benefits. Second one is avoid excessive volatility and contribution rates over the intermediate term. We do that by maintaining a moderate risk profile. Third item here is achieve cost efficiency in the program. That's something we've obviously spent a lot of time on. We do annual CEM study, which they present to you every November to kind of show our cost efficiency. Exceed composite benchmark returns for the fund and for asset classes over long time periods, over market cycles. Ensure sufficient liquidity to make sure that the fund's obligations are met over all time periods and in perpetuity. And then obviously comply with all governing statutes as consistent with our fiduciary obligations. So these are really the main 6 objectives that we have and that we set forth in our investment policy. Next slide shows kind of our strategic asset allocation and asset categories. And you know, you guys have all sat through these meetings multiple times, and you see us talk through these every quarter. You know, the policy sets forth these asset categories based on their anticipated role within the portfolio. So the growth category is really the return-seeking part of the portfolio. Rates and liquidity is really focused on capital preservation. The inflation-sensitive and diversifier portfolio provides a balance of capital appreciation and current income with a positive relationship to inflation. And then we have the multi-strategy piece, which really provides investment flexibility across asset categories and allows us to have flexibility to potentially do kind of total plan type strategies. Slide 5 shows the changes to our strategic asset allocation. You can see our old targets and our new targets listed here, and then the changes for those. The main changes here, you can see the largest changes from our old to our new target was public equity went from 42% to 38%, so a decrease of 4%. And again, this is policy target. And then cash went up from 1% target to a 5% target. So a 4% increase in cash, 4% decrease in public equity. Then we also tweaked our allocation to private equity, increasing that by 1%, and decreasing our multi-strategy target from 2 to 1%. All the other asset classes remain the same as we've had for the since 2013, I guess.
There's a question, if I may.
Sure.
Which of these asset class, are there any asset classes other than private equity that dictates our percentage of investment based upon statutes?
Yes, well, you're just saying how we measure against our statutes.
If the legislature says we don't want you investing more than make a number of 8% private.
So there's specific caps and minimums in certain circumstances around really all these asset classes.
Okay.
And it's in the back of the slide deck. We can jump to that now, or we can get to it later. It specifically shows what that is. But yeah, so each asset class, there's caps or minimums for really all of them. So we just have to make sure that our investment policy fits within the statutory limitation as defined in statute. So there's a slide right at the end that shows exactly what that is, and I'll walk through that. But it's not just private equity.
Thank you.
Sure. So slide 6 here lays out our new policy targets as well as the new policy ranges. You can see that public equity and IG fixed income, the ranges are set to plus or minus 5%. So really for the public markets, we have more control over those. And so we set the targets to plus or minus 5%. For the alternative asset class ranges, they're generally set around those statutory caps, so that we don't exceed those. So that's why some of the maximums here seem a little bit odd, but it's basically because of the cap. So you see like private equity is 8.75% max, and then opportunistic fixed income inflation there at 7.5%, real estate's at 10. That's because of all the caps set by statute. So we don't really have any flexibility around that. So that has to be the maximum. So that's really where some of these maximums come from, where it's just based on those statutory caps, which is why some of those ranges may seem a little bit odd, but.
And that's based upon 8.75% of investment, not overall percentage of the portfolio, meaning that private equity goes great and suddenly it's 10% of the portfolio. We're not forced to sell it back down to 8.75.
It's measured by market value at any given point in time, but we do not have forced selling if that were to happen. So and again, a lot of so for example, private equity's gone up pretty significantly, even though we have gotten a lot of cash back because the portfolio has done really, really well, right? And then this year, public equity, the denominator effect really affects it, right? Public equity's gone down, fixed income's gone down, private equity's gone up. So just by that, their allocation's going to go up. Hasn't gone up significant enough where we're pushing against these caps yet, but that could happen, right? In an environment where equity markets are going down, it's a big part of our portfolio, so the market value of the portfolio as a whole goes down. These other asset classes don't do well or don't do as bad as public equity. And then we've seen that in the past, and we didn't used to have those the ability to hold if we go over that. We actually were forced to sell back during the financial crisis. We went over those caps because of the fact that public equities went down so much. So our private equity was over the cap. So we were forced to sell in the secondary market back then. This is going back well more than a decade, which hurt the portfolio as a whole because we ended up selling those things
that we're doing well,
and we ended up selling really, really good funds that ended up doing really well if we would have kept them, right? So we were forced to sell certain funds because of that, which hurt the portfolio as a whole. So we were able to get the statute changed where we're no longer forced to sell in the event that we would go over these caps. Now, we couldn't make new investments. Similar, same thing that we talked about with Jeff's portfolio on the downgrades of the fixed income, right? We wouldn't be able to invest in that if that were the case. So we try to forecast that pretty closely. We run cash forecast models and we try to do a lot of scenarios around that, but you never know what's going to happen. But we try to be pretty intentional to not push up towards those caps in that event where it would go over, because the last thing we want to do is not be able to make new investments if the opportunities were there to make new investments, right?
Chris.
Yeah.
One word we haven't heard this morning is recession. So how do you deal with recession and whether or not the risks are we approaching recession?
Yeah, I mean, I think there's a lot. I mean, obviously there's a lot to that. I mean, I think the economy and the markets are two different things. So we try to just maintain a diversified approach in all environments, right? Because we can't pick the top, we can't pick the bottom. we just need to maintain our discipline in our investment process and in our investment philosophy, regardless of the environment. Obviously, we take advantage of certain scenarios, but whether we're heading into a recession, equity markets are down close to 20%, right? So does that mean they're going to go down more? Or does that mean we're at the bottom? Nobody really knows. So I mean, it's for us, it's taking a very long-term view on it, regardless of that. I don't know if Jeff has anything to add there.
I think your policy and your ranges and what you're setting up should and does reflect that possibility at all times. And we saw really when we turn back to the previous meetings with Cowan, some of those scenarios were modeled in to the data. So you see kind of in that really bad environment, what happens to the plan, what happens to funding, all these scenarios. So really your policy should reflect all those different variables and all those different chances on it. I think what Chris is touching on is then you kind of think, well, I look at the way that a lot of those things are expressed as where you are within your ranges of policies on what you think of where markets are and that kind of things on it. But your target really should reflect all those different variables over time and all those possibilities over a long cycle of the plan. So it should be baked into the process here, and I feel like it is. And then there's thoughts on how you operate within that, like we talked about with the fixed income, right? What things can we do within that to protect the portfolio or add value where we can, or back when we had spreads blow out, we took advantage of things like that too. So I think you want a plan that can withstand those scenarios and also give you some flexibility within that to take advantage of or protect from when those different ones happen, because that certainly is a scenario that feels more likely, I would agree, than others in the near term.
I would add, Lars, to your question that there was an article in the Wall Street Journal over the last week or so called The Lost Decade. And there is a possibility that as far as stock prices are concerned, that we might be facing the lost decade in stocks on a return basis. And as I said to too many people in this room, we don't pay benefits with Bitcoin and benchmarks. We pay cash. And we had to remain in the check delivery business. And so whether it's stagflation, recession, or the lost decade, these are possibilities. I have full confidence with all the things happening in our world and all the grief that we're all suffering this morning, that our participants continue to be in one of the most safe, secure, best funded pension plans in the United States, if not the world. And I also remind those that are a lot younger, I was, pumping gas in the early 70s. And I believe between 1973 and 1985, if you had put $100 into American Express, Procter & Gamble, IBM, AT&T, Coca-Cola, Pepsi, you lived through this. If you had put $100 in each one of those companies, it took on average to 1985 for the $100 to be worth $100 again. Not to double, just for the original investment to be worth investment. So this article that wasn't pointed out, what I just told you in this Wall Street Journal article, but it's a serious issue, because at the end of the day, we don't pay with Bitcoin or benchmarks. We pay with cash. We have to, which they're doing a fantastic job of managing the plan that keeps us in the check delivery business, and also doesn't put us so far out over our skis that General Assembly can't fund the plan for the cities and counties. You remember that period, don't you?
I do. And,
did I overstate it?
I think it's very hard for our members to understand how difficult it is to keep the plan, and also how important it is to keep the plan safe and continue the benefits that we currently have. And the market dictates whether or not there can be any advances in those benefits, which right now looks very, very bleak.
Essentially more on the topic. So, from my 30 years here, you get into this process, you talk about trade-offs of return and risk, right? When things, if we go back in time here a year ago, we think about like markets are going gangbusters and what are your returns and how are you doing? Everybody wants to talk about the return side of things. And when things start to go sideways, then everybody wants to talk about the risk side a little more. So typically, as you saw on those charts earlier with our peers stuff, we're always going to be on the lowest risk profile, right? And that's easy to pick at when things are going great. Typically, you heard me give that stat on once in the last 50 years. Typically, we're going to see the fixed side of things really star and kind of really do well during that period. And typically, that's where we'll really see us kind of gap out a little more over our peers because of that. In this case, we're not any worse off, than they are as far as the return side of things, but the market hasn't done the same, and the exception of 50 years on it has kind of put us down there where, we're still lowest risk, but we're not benefiting as much from that low risk profile on the return side of things because of what's happened in fixed income. But it's always the cycle that goes through on what are you going to focus on, the return or the risk side in the process. And it's funny how people think of change depending on what's going on.
And just to be clear, not to make it say longer, I think this is the first time in any of our lifetimes, including yours and mine, that we've had a sequential, our guest speaker will probably comment on this, a sequential year over year, month over month decline in both stocks and bonds.
Yeah, I gave a data point on earlier. Ever.
So, like you said, difficult but important.
Right.
Yeah, I'll keep on moving. I'll try to get through this quick in the sake of time. So slide 7, this is shows a snapshot of where the portfolio stands versus the new targets and ranges. This is as of 3/31, so the portfolio shifted a bit since then. You can see that the underweight to growth and overweight to rates and liquidity have decreased with the new targets, although the portfolio is still positioned conservatively versus the new policy. And then this slide, I want to make sure I hit it. This is really the important piece. So this is the updated projected ranges of investment returns. That was the outcome of really that whole asset liability process that we went through. You can see here on the bottom table here, it shows the expected returns for the portfolio for the next 10 years and the next 30 years. So the portfolio is expected on average to return 5.7% over the next 10 years and 6.3% over the next 30 years. And again, we've talked about, the difficulty we see in the intermediate term, given where rates started. Obviously, we've seen a big shift in that this year, but which obviously equated to some pretty negative returns. But, as we went through that process, we talked about how, it will be difficult for us to hit that 6.5 without taking on a good amount of additional risk. And that kind of shows here where, the projected returns we're seeing is about at 5.7% versus the actuarial rate of return of 6.5. And then the table on the top right there, you can see the probability of us meeting or exceeding that 6.5% investment return. So that's at about 39% over the 10-year and 46% over the 30-year. Then I'll just hit these other slides real quick because I know we want to move on to the next agenda item. So the policy lays out a lot of items within it around risk management controls, guidelines. So the next few slides really just highlight a lot of those. So this talks through kind of some of the risk standards and metrics that we track. A lot of these you see in the quarterly reporting that we show you. Talks about volatility, returns, liquidity, tracking error, cost effectiveness. So those are all set forth in the policy to ensure that's being tracked and being managed. Slide 10 goes through our fund benchmarks, and we talk about these every time as well. Each asset class has their own benchmark, which is appropriate for what they invest in their strategy. At the total fund level, we have the two main ones, the long-term policy benchmark, which compares the performance of the fund to a low-cost passive publicly traded portfolio that represents the the broad allocations to the fund's core drivers of risk and return. And then the implementation benchmark, which is really the weighted performance of all the underlying benchmarks at the portfolio target. Slide 11 goes through some of the implementation guidelines, talks about how we can manage capital in the interim, really how we can over and underweight the portfolio based on kind of tactical asset allocation. Talks through active management, the utilization of active management to try to get excess returns. Talks through internal and external management and how we can utilize both of those based on what's going on in the market, what's going on with our resources, and kind of skill set of the investment management staff. And then it talks through how we select and monitor investment managers. And really it just kind of points to two of our subsequent policies, our external investment manager policy, selection policy, and our monitoring policy. And then slide 12 just hits, again, some more general portfolio guidelines that are laid out in the policy, really for risk purposes and to help us implement our core beliefs and really help us meet objectives. And a lot of these are around what we can invest in through through different legal structures, how we diversify the portfolio to ensure we have diversification across asset types, asset categories, geography, sets limits around how much leverage we can take, as well as sets limits around concentration from a firm perspective or strategy or fund perspective. So we have specific guidelines within the policy to ensure that no one portfolio is taking on too much risk and that we're properly diversified across the entire investment portfolio. And then the last slide I'll hit here, slide 13. This is the statutory compliance slide, which Greg asked about earlier. So this lays out the specifics, minimums and maximums we have for each asset class and the actual general statute that references that. So investment grade fixed income, we have to have at least 20% in the portfolio. For public equity, we can't have any more than 65% of the portfolio. And then for each alternative sub asset class, you can see that there are specific limits around those. And you can see, where those sit. And then line 8 there, the last line there, we have a cap around our aggregate alternatives as well, is that we can't go over 35% of the market value of the portfolio in aggregate of essentially lines 3 to 7 there. So those are set by statute. So those, obviously we track that daily and ensure that we're not bumping up against any of those limits. But in the event, as we talked about before, in the event we did go over, there is no forced selling rule within statute, but we wouldn't be able to make new investments if we were over the cap. So that's really all I have prepared for the investment policy review. Happy to answer any questions on the policy itself or any of the changes we made based on the asset liability study that we completed. But yeah, I'll leave it up. Any questions, I'll be happy to answer. Questions?
Thank you very much. Great job. We're now just honored to have Dan Clifton from Strategas join us. Those of you who have not heard his presentation, you're in for a real treat. And we appreciate you making the effort to come down. Matt, where do you think's best for him to sit? That's a good sign. Okay.
Great. And is there a clicker?
I'll move forward.
Okay, great. Excellent. Well, good morning, everybody. Thank you for having me. It's great to be here. I want to first congratulate North Carolina. This morning we got what's called IRS migration income data, which shows us not only the number of people who move in and out of the state, but how much money they've taken with them. North Carolina came in 4th in the country in 2020 for income migration, a net $4 billion. I think that's the ultimate sign of where people go. Voting with their feet is where people want to be. So I'm sure there might be a little bit of traffic that comes associated with that. But I think that this is a real sign that policy is attracting capital into the state. And I think that's going to be more important in the future. The loss of the state and local tax deduction that happened a few years ago, changing from work from home, and we're starting to see these migration trends begin to accelerate. I'll just give you one example. New York lost $25 billion of income in the first year of the pandemic, and we know that migration accelerated the following year. We just don't have the income migration data from that, so there's probably going to be more gains there for North Carolina. Second thing I want to say is that, I usually come in here, I'm pretty optimistic, things generally work itself out. Today I come with a sign of caution, a bit more caution, because I do believe that there are structural changes happening in multiple parts of the policy spectrum, whether that's monetary policy, whether that's fiscal policy, whether that's geopolitical policy. I actually think the framework by which investors have been using for the last 40 years is beginning to change. So the title of my presentation today is 1982 Deja Vu. It's the last time the Federal Reserve actually had to get inflation out of the system. If you think about every interest rate increase that we've done over the last 40 years was designed to keep inflation under control, okay, or to prevent inflation from happening. This is actually trying to get it out of the system, which is much more difficult to do. 1982, we were also dealing with Russians. That's new again for us. And it was a midterm election year. I will show you today that midterm election years have very big impacts on the equity markets in terms of how equity markets respond this year compared to other years. One other point before we go on is I'm actually starting to shift as I start to think about where we're going. And there's a lot of analogies today to 1970. So this 50-year cycle that we're in, if you look at the S&P 500 today, it's the worst 100-day start for the S&P 500 since 1970, which is a very important data point because you remember during our election presentations, which I know Jeff had to sit through a couple of these, we kept talking about 2020 being unprecedented, but nobody really knew what that meant. So we went in and we measured what was going on in 2020. And we had these events happen, 4 events that were just transformational events all happening at the same time. We had a presidential election. Whoever wins the president changes things a lot. We had a pandemic, the first time since 1968. We had mass protests. And while we had a recession, we didn't get the recession until 69. But the only comparable period that we had to 2020 was 1968. And now the S&P is trading a lot like 1970, which was the first midterm election after 1968. And that's important because we had an OPEC oil embargo, we had a war, we had inflation, we had a change to the Bretton Woods, which was a major change to the global financial system. And so you're seeing these kind of big structural changes happening, very similar to the post-1968 period. And why I think some of these issues that we're going to talk about today are more structural and less cyclical than we normally do itself. So if we look at the first slide, this slide I've been showing for 10 years. I've showed it here multiple times. Our big thesis is economic volatility is creating political volatility. That really applies to the US, but you can do this around the world. And we're about $4.4 trillion short of economic growth today than where we were growing by the historical 3% growth rate. We've largely been here since the financial crisis. And the reason why we believe that this economic volatility is creating political volatility, if we look at the next slide, this is the most political volatility that we've seen in the US since the financial crisis. And so ever since we transitioned from a 3% to a 2% growth rate, the US voters have been changing political parties every 2 years. We've had 8 federal elections since the financial crisis. The voters of this country have removed the party in power in 7 of those 8 elections. I'm likely going to show you at the end of my presentation that it's probably going to be 8 of 9, given the trends that are going on in the House of Representatives right now. And so if you think about it, you look at the next slide, is that what is happening here is that political volatility is turning into policy uncertainty. 2 years, president comes in, cuts taxes. 4 years later, you're trying to raise taxes, or you're doing healthcare reform, and then you're trying to repeal healthcare reform. And so what we've been seeing is higher levels of policy uncertainty. That's reducing the appetite for capital expenditures, and it's becoming self-fulfilling and keeping U.S. economic growth down to a certain extent. What I want to show you on this chart on the right, though, is that a lot of money is made in equities when policy uncertainty is high. We looked at this University of Chicago Stanford index, and we said, okay, what happens when the index goes over 200, which is a high policy uncertainty rating? You outperform, the S&P goes up 19% 1 year later. So while I'm going to talk about some uncertain things, doesn't mean that we can't actually do well in equities as we start to think about some of these changes that are happening. But I do want to stress that the structural changes on top of it are pretty significant. If we look at the next chart, this is a midterm election year. And so what happens is in our midterm election years, we literally grit our teeth in our office because we know there's going to be a big sell-off coming. Big believers in the presidential cycle. There's 4 years to a presidential term. Year one, the average S&P 500 intra-year decline is 13%. Year three, it's 12. Year four, it's 13. But year two, the midterm election year, it's much larger. It's a 19% intra-year decline. We don't know when it's going to happen. We just know it's going to happen. And this year it happened faster and larger than it normally does at the beginning of the year. The good news is that these turn out to be excellent buying opportunities, with stocks up 1 year later by an average of 32%. But you still have to go through that mid-year, intra-year correction. I would also note that we just hit that 19% average like yesterday. So we're like right at that kind of average level. But what you see is you tend to get this kind of sell-off that goes into the election, and then you start to rally out of the election. The big question is, why does this happen, and why is it happening this year? If we look at the next slide, and that's because presidents love to do fiscal policy stimulus in their first year. They flood the system with tax cuts and increase in spending. The second year of that 4-year cycle, the Federal Reserve has to raise interest rates. The red chart shows you the interest rate, and the blue bar shows you interest rate cuts. Red is interest rate increases. And what this shows is that the Fed has a much higher bias towards raising interest rates in the midterm election year. They usually raise rates until they break something. And then if you look at the third year, you see that the Fed loves to cut interest rates in the third year of a presidential term. And so the equity market figures that out. The way I explain this is that we're eating our spinach this year, and boy, do we have to eat a lot of our spinach. We shut down the entire U.S. economy and had a pandemic and a recession, and stocks went up. It's the first time probably ever in history that we had a recession and incomes grew. Okay, now we're in the opposite. We're not in recession, but incomes are starting to shrink. If I can really jinx you here, really jinx it, the S&P 500 has not declined in the 12 months following a midterm election since 1946. Okay, so sometimes I say this, I've been doing this 15 years, every midterm election cycle I do it, did it in 2006, 2010, 2014, 2018. My clients will be like, oh, this is just like the Dallas Cowboys winning the Super Bowl and stocks doing X, you know, like they treat it almost like voodoo itself. But there is something to this cycle, given the way fiscal and monetary policy interact. And it shows you that the Fed is a political animal. The Fed really does not want a bad economy in the presidential election year and tends to cut interest rates before that presidential election year so that the economy is humming ahead of the election itself. There's a lot of people calling for a recession in next year. It would be the very first time in modern U.S. history that we ever had a recession in the third year of a presidential term. Most recessions happen at the end of a presidential term or at the beginning of a new presidential term. And that's because we do everything we can to avoid that recession before the election. And then you get this massive hangover that results from it. So the cycle is working very well, other than the kind of recessionary impact that we're in right now. If we could look at the next slide. And so why do I call this 1982 deja vu? Ulf and I joke, like, none of our clients really have a good understanding of what's happening right now. It's the very first time I've ever seen that. Like, we can walk from meeting to meeting and get totally different perspectives. And so for us, this became our framework at the beginning of the year. 1982, Fed's trying to get inflation down, midterm election year, Cold War. It's worked really well. What's happened over the last month is that the decline that we saw in the summer of 82 has actually pulled forward a lot this time around. But you can see, just like all previous midterm election years, you got that rally into the midterm election and out of it. What triggered that rally was that the CPI fell to about 6%. So if you look at 1970s, we had two instances where CPI fell to about 6%, and then equities rallied. The same thing happened in 1982. The good news in 82 was that we were crushing inflation for the next 40 years, really, or at least for the next 8 years, you could say. And we had a very high unemployment. Today, it's very different because we have a very low unemployment rate, and inflation may be with us a little bit longer. But let me show you the next chart. This is the 1970s chart. I mean, it's the last 2 months have just been the same chart as 1970. Again, midterm election year, and came after the last pandemic, and really where we were at the beginning of the inflation process. What drives the Federal Reserve is to prevent this from happening again, where we have a 10-year, 12-year inflation. They are willing to put the U.S. economy into a recession if it means that they're able to get inflation out of the system. And so what you've been seeing in the market over the last couple of weeks is that the market is now starting to say, okay, we're more concerned about growth than we are about inflation. Okay? That's why you're starting to see the 10-year come in a little bit here. Okay? I don't think the two are mutually exclusive, to be honest with you. You can have slow growth and high inflation. So you really have to make sure you're getting the inflation out of the system. And there are events that I'm going to show you in a few minutes that kind of mirror what happened after the 68 pandemic and 68 recession. We look at the next chart. And so why do I think we're in a framework change? It is very rare for one of the three stools of policy to be upended. All three of them are being upended at the same time. That's fiscal, monetary, and geopolitics. This is just a simple chart in red of CPI and the blue of the 10-year Treasury. We have never in history have had a divergence between inflation and interest rates like we're seeing right now. At some point, these two are going to have to converge. And it doesn't mean that interest rates have to go to 9%, but at some point they're going to have to converge. And that means that the Fed is going to have to be more aggressive than I think the consensus anticipates. The second chart shows you the change in the budget deficit, the largest deficit reductions in U.S. history post-World War II. And so what you see here is that the post-World War II deficit reduction was about 14% of GDP. This year it was expected to be 9% of GDP, the second highest ever. And what you see is that number is probably going to be about 12 or 13% when the Congressional Budget Office releases its revised budget numbers at 2 p.m. this afternoon. So this is a World War II drawdown of fiscal policy that we've just gone through over the last 13 months. And it's, by the way, it slowed the economy down, but it hasn't really changed the inflation. Now, a lot of my clients say, okay, Dan, CPI starts to decelerate, the Fed's going to do 7-8 interest rate increases. I'm going to go buy tech stocks now because I can put that in my model. And so, hey, if you tell me we have a recession coming in 3 months from now, that's actually the bullish case for stocks, my clients tell me. Because then Congress is going to come in and they're going to hand out checks and we're going to replay that cycle all over again. I think it's very unlikely that we're going to get any meaningful fiscal policy with a debt to GDP ratio of 120% right now. I just don't think that that's going to happen. And so using that old model of fiscal stimulus during recessions, I think is going to be very unlikely and even more unlikely post-election. If you're going to do something on policy, it's going to be more focused on energy policy than it would be on fiscal policy per se. If we look at the next chart. And I just want to show you, because I think if I've been on the road almost every day in the month of May. And if I told you the greatest misperception amongst my clients is reflected in this chart. This is M2, which is basically the money in the system. And what this shows you is that we've always grown by about 6% per year. Okay, we have $4 trillion of excess liquidity in the system right now. Now, the good news is we're growing at 6, but we're growing at 6 with all that excess liquidity in the system. And so this is why the draining of the balance sheet is going to be so important for the Federal Reserve to get inflation out of the system. Because we talk about supply chains and Putin and all this other stuff, but those would be viewed as supply shocks by the Fed if we didn't have broad-based inflation, and the market would be looking through it. The reason why those issues are important is because it's happening on top of this, and we have broad-based inflation. So that's why I think we need to grind our teeth here. We have a lot more wood to chop, and some people are talking about the Fed stopping after the next 2 meetings in terms of its rate increase. How much they drain out of the balance sheet will be the critical factor. If we look at the next slide. Probably the coolest chart I could show you. Very unrecognized by institutional investors. We've had a complete V-shaped recovery in the budget deficit since COVID happened. The budget deficit today is just slightly below where it was before COVID hit the United States. Most people do not realize that. By the way, you got to take a look at North Carolina tax revenues. They are surging. I've never seen state governments in better operating budget shape today than I have ever seen in my life. And the reason for that is that the federal government paid the COVID and education expenses. State spending as a percent of GDP is its lowest level since 1969 today. And now you have all this tax revenue pouring in. It's higher incomes, higher capital gains. It's higher corporate. And the reason why I bring that up to you is that the federal government tax revenues as a percent of GDP is 19.4% right now. It is likely going to be 19.9% at the end of June, which would break the all-time record for tax revenue. So we have $1 trillion deficit, and we have the highest level of tax revenues ever collected in the United States history. And that's a major fiscal tightening that's happening. It tells you there's still some spending that has to come out of the system before we start getting that under control. So I still have spending that's got to come down. I have the Fed that's tightening. The good news is we're past the major part of tightening, but there's still portions of this tightening left. So look at the next chart. And so what's happened, the combination of higher inflation and fiscal tightening is eroding the real incomes of working Americans. This is a chart of after-tax, after-inflation income. And what this shows you is that in the next couple months, there's a possibility that American income is going to be below where it was before COVID hit. Right? So you think about it, like the deficit exploded, now it's back to pre-COVID levels. Incomes may be going back to pre-COVID levels, and that is very, very bad. Okay, one reason why this is why consumer confidence is at 50 in the University of Michigan survey that hit Friday. We put it into our election model. This is the biggest driver of our election model. We take great pride in our election model. We've gotten every presidential election right, including 2016. The election was held today. Biden would get 40% of the vote based on where inflation is. Now, the election isn't for another 2.5 years. You cannot extrapolate today to 2024. But we just put that in just to show you the historical context of why consumers are feeling as bad as they're feeling right now. So these are big changes that are happening, and most Americans are not used to it. On top of that, if we look at the next slide, this is like we're having a major thank you so much. We're having a major geopolitical upheaval. And we can talk about Russia, Ukraine, but the most important event that happened this year is Putin and Xi Jinping standing up at the Olympics and saying the new world order is changing. This is why Finland is trying to join NATO. They've never done this before. This is not normal. What Finland is saying is we believe that there is going to be continuous geopolitical threats on our doorstep. Okay, these are big changes that are happening geopolitically. And that's why we're starting to see these big rises in geopolitical risk happening. And that means that the framework actually has to change, because what you're doing here is you're ending the post-Cold War period, and now you're entering Cold War period 2.0. And that's going to have asset allocation implications. Let me just show you this next chart. I met with the European Union, I don't know, maybe 2 or 3 weeks ago, 3 weeks ago. The European Union is a very difficult policy-making operation because you got to get 27 countries on board with what you're trying to do, and so they never can get anything done. Okay, I didn't know who I was sitting in the room with. These are people I've known for years, and they're literally like, we will have an LNG import terminal in Germany hooked up in 10 months from now to the electricity system. We are all increasing spending on defense to 2% of GDP. And things that they would never do. This idea is that if there's not enough energy, Volkswagen may have to locate in North Carolina or South Carolina or Ohio to be close to the energy sources, given the way that the energy distribution is beginning to change, right? These are huge shifts. Trump went to the European Union in 2018 and told them, like, you got to do this. And they laughed at him. They used to tell me, oh, he'll be out of office in 2020. We're not doing any of this. Not only are they doing it, they're doing it with great enthusiasm because they see that existential risk on their doorstep and are beginning to change. So that's a major change in our viewpoint. The second is what worries me the most is what's happening with Saudi Arabia. Saudi Arabia is entertaining the idea of joining the alliance with Russia and China. And the idea you would do that is that you would do that and then China would be able to price oil in the Chinese currency rather than in the US dollar. And so if you had that event happen, which I don't think is imminent, but if you had it happen, say 4 years from now, it would start putting kinks in the US as the reserve currency. The chart, the very ugly chart that I have up there in lines, is the US China currency and Brent crude oil. What this shows you is that as the US currency depreciates relative to China, oil goes up. And I show you this because there's this great mystery going on in financial markets why the regular dollar, DXY, is going up and oil's going up. It's never happened before. What I'm arguing is that it's less about Europe now and more about China, which makes sense. China's the biggest producer of oil overall. This is why it's important when the president goes there in June. The president's probably going to have a meeting with Saudi Arabia, and the president is trying to basically cut a deal between Israel and Saudi Arabia that would kind of close up the Abraham Accords that started under Trump. These are big moves that are happening because you don't want to see that kind of polar war developing, or the two polar worlds developing. And I would argue that that's happening anyway, and it's going to impact supply chains. So what does all this mean? This is all fun to talk about, but there has to be investment implications to it. If we look at the next chart. You know, I only use the term ESG not to be quirky about the ESG movement, but I don't know if you noticed this, but Larry Fink at BlackRock put out a statement yesterday that he's not going to support a lot of shareholder resolutions on ESG because of this changing framework that's happening. I call it ESG just because the letters fit very nice and people know ESG, but I believe the investment implications are a move towards energy, which includes all the above: oil, natural gas, nuclear, wind, solar, EVs, hydrogen. All that's going to be a big part of it. And a big part of it is getting energy storage in place. Then there's security. The defense stocks continue to be underowned. The cybersecurity continue to get lumped in with tech. But I've never seen a greater tailwind for defense spending in the 25 years that I've been in politics, other than in a post 9/11. And then 3 is governance, where I think that companies need a seat at the table or they risk getting burned. And I'll just give you one example. We're doing a China competition bill. House passed a bill, Senate passed a bill. They're trying to negotiate this bill right now and come up with a consensus. There's a provision in the House bill that says to a company, if you're going to put your supply chain outside the United States, the U.S. government will do a national security review on that supply chain. We have had inward reviews like, oh, is China going to invest in this U.S. company? What are those national security risks? We've never had outbound reviews before. And by the way, this is the way the world's moving. The U.S. is moving towards an industrial policy. And so the big implication from that is that we're probably going to do a lot more inshoring and a lot more friendshoring, where we're going to have our supply chains basically where our allies are as we go into this multipolar world. And so if you think about that, the net result is that you're going to have higher costs, you're going to have higher inflation, and you're probably going to have lower PEs on stocks as the world moves in. These are not imminent changes. These are long, slow moves, but those moves are clearly happening in place right now. And I think investors need to adjust to this sort of changing framework. Best way to explain it is we spent 40 years trying to do supply chain efficiency, and it worked amazing. But now it's about supply chain resiliency, so that you don't get caught up not being able to get masks if there's a pandemic, or ventilators because they're stuck in China. Less investment in China, more investment in other places, and more investment coming home. Look at the next slide. I just went back in and I looked, because my clients just totally frown on me when I talk about defense spending. My client, well, we went in and we said, okay, what happens when geopolitical risk goes up? You get major outperformance of defense stocks. 1 year later, it's about 19%, or 9 months later, it's 19%. 1 year later, it's about 16%. These stocks are completely underowned. I had a large mutual fund that invested in one of my portfolios, my policy portfolio, and I used to have to take the defense stocks out every quarter because they couldn't invest in them for various reasons whatsoever, right? So the ESG probably has made those underowned. Chart on the right is our lobbying basket, and how our lobbying basket produces in better policy uncertainty, and it outperforms by about 250 basis points 1 year later after you have that high policy uncertainty. And that's our kind of governance governance bucket that I just put forward. So energy, security, governance, I think are going to be the key to outperforming in the future. This is probably more short-term, medium-term than the pension fund is focused on, but active management is still the biggest takeaway from this, and caution and changing in asset allocation. If we look at the next chart, this is just our global asset allocation policy fund. We call it the Global Lobbying Fund. Its benchmark is the ACWI. We launched it on January 25th, seeing these trends. We've outperformed by, 600 basis points. The performance has been really good, trying to incorporate these themes in there. And so if we just look at the next chart, I just want to talk about China tariffs quickly, because everything I just said can be completely contradicted by President Biden in the next 24 hours or 48 hours, right? Like, oh, the world's moving in, the world's moving in. I leave here. Biden comes up to stage and says, we're getting rid of Trump's tariffs on China. Completely contradicts it. And the reason why I bring this up to you is the president said in Asia this week that he's thinking about getting rid of these tariffs. I think it will be very difficult to do. I think it will be difficult to do for two reasons. One, China hasn't met its phase one trade commitment obligations. Number two is that the politics, there's not many bipartisan things in amongst voters, but China is one of those bipartisan things. And so I do think that it's probably going to be tough to change those. What I see Biden doing is he's basically throwing out his fishing rod to China. China's economy is slowing down very considerably right now. And they have a very important election in October where they want to have faster GDP growth than the United States. They want to have better COVID than the United States so that J.J. Ping can say that he's defeated the West, where he's got a superior model to the West. I think Biden's saying, hey, you want better growth, we'll be willing to entertain the idea of getting tariffs off, but you're going to have to pay up for that. That's what I think the president's trying to set up. I think it's going to be very difficult to do. And so the way I would think about it is that we're likely going to see a broader exemption level for companies that are in the supply chain that could be impacting U.S. inflation rather than a broad reduction in the U.S. tariffs itself. Look at the next chart. Build Back Better. When I talk about Build Back Better, I really lose the crowd. So if I haven't lost you yet, I probably lost you here. Most people say Build Back Better isn't going to happen. Senator Manchin went to Davos this week and said he would entertain the idea of Build Back Better. I call it Build Back Smaller, what we're looking at. These are kind of the components. I think there's three big tax increases: tax increase, minimum corporate tax rate on multinational income, and a surtax on very wealthy individuals. That's designed to pay for climate change spending and to pay for ACA subsidies overall. We look at the next chart. Unfortunately, I put this chart in yesterday before Manchin's comments got out there. It's about a 33% probability of Build Back Smaller passing by September. This allows the Democrats to pass legislation with 50 votes. It's called reconciliation. And I just show you this chart up there. Those are companies that would be impacted by the corporate tax rate increase. What you see is last Memorial Day, President Biden put out his budget. He had significant corporate tax rate increases. The companies that were most impacted underperformed from May all the way to December. When Senator Manchin went on Fox News and said, I'm not going to do that corporate tax rate increase, you saw a dramatic outperformance of these companies. So if people tell you this stuff doesn't matter, that chart proves it wrong. And I'll just show you the next chart overall. And the red line is a totally different set of companies. Those are companies impacted by drug pricing legislation. It's literally the same chart. Again, outperformance as we start, underperformance as we started to think about drug pricing, outperformance as soon as the bill cut debt. Okay. The Democrats are probably not going to be able to bridge their differences on drug pricing, on corporate tax changes. There's been a lack of appetite amongst Poland to do a global minimum tax, which I think is considered needed to get done if the U.S. is going to raise its taxes on U.S. multinationals. I just think the Democrats are going to make one last shot at this. Just show you the next chart. These are the climate stocks. They're really not doing much here, largely because of the uncertainty on Build Back Better. I do think there will be a bid for them in the future, though. And then if we look at the next chart, just show it up. Let me just go back. I might have forgot it. The key issue here is that 4 million people are going to lose their health care if we don't pass this bill, because the ACA subsidies are going to expire. And so my sense here is that if they fail on Build Back Smaller, they're probably going to move to some smaller health care bill, which seeks to at least get those subsidies in place for at least 1 year. So that's why I think something still is going to pass. I just think what's being negotiated on big tax increases and drug pricing remains unlikely. And then finally, I've talked way longer than I wanted to. I'll just show you this chart. The president's approval rating in Gallup yesterday came out for the month of May. We like Gallup because we have data all the way back to Eisenhower. Midterm elections are referendums on incumbent presidents. And Biden's numbers fell below where Trump's numbers were in the month of May, which is just an amazing data point where we just don't like our presidents after we elect them to have two presidents this low. You usually only get this low if you have high inflation. Trump didn't have high inflation. He was still that low. So my point here is that the president at 41, 42%, that's a very low number by historical standards. The chart on the right shows you that it's being completely driven by the price of gasoline. So we can talk about gun control, we can talk about abortion, we can talk about all those issues, and they do have an impact on the margin. But the overwhelming issue right now is gasoline prices and inflation. I'll let you plug in your own gasoline forecast, your own inflation forecast by election, but probably not going to be enough to turn the tide. I'll just show you this. This is the last chart I'll show you. That scatter plot is every president in their first midterm election, what their approval rating was, the number of lost House seats. This shows you that the Biden and Trump are right next to each other. Trump lost about 40 seats. The Republicans would argue that they're probably only going to gain 25 seats rather than 40 because the Republicans gained 12 seats last year. Very rare for a party to pick up seats in the House and lose the presidency. Just never happens. But overall, the Republicans only need 5 seats to take over the House, and they seem poised to do that. Where the uncertainty is amongst investors is in the Senate, by the governor of Arizona and the governor of New Hampshire not running as the Republican candidates. It makes it harder for the Republicans to pick up those seats. You're also seeing controversy in Pennsylvania right now. And so because of that, I think the market is still a little bit undecided. They think the political environment favors the Republicans, does, but that on the other side is that candidate quality matters. And there is a chance that the Democrats could probably maybe keep the Senate 50-50 or 51-49. That won't be known with confidence until you see all the primaries play itself out. And we still don't know who the candidate is in Pennsylvania here 9 days later. Okay, something wrong with our voting system when we don't know that. But to me, that's going to be the big issue. Is this a ripple? Is this a wave? Or is this a tsunami? Right now, the market is pricing in a wave. If you're going to go in either direction, a ripple meaning that the Republicans don't win by as much, or a tsunami, the Republicans win by much, I think will start to impact particular sectors. If we don't get an energy bill done this year, it's very likely we're going to have to do an energy bill next year, given that energy is the overwhelming issue and will continue to be with us just based on where inventories are, based on geopolitics. And that's kind of how I see it really playing out. But we could be facing 2 more years of gridlock after this election. Thank you for having me today. Appreciate it.
All right, questions? Can we have a motivational speaker come sometime and talk to us?
Listen, I'm very optimistic all the time. I'm usually motivational, but I was at the NEPC conference. I don't know if you use NEPC. They work with a lot of the state pension funds. You guys don't need it. Most of them are passive managers.
That's politically correct.
What's that?
Politically correct conference?
No, NEPC, they're like investment consultants.
All I heard is, have you been to a PC
No,
conference?
NEPC, I'm sorry. So they had a motivational speaker come on before me, and he just wowed that crowd out there. I was like, oh man, he put me in a tough position. But you know, my point is that, look, we did okay during the Cold War, right? Like, and we're going to do okay. It's just that for the first time in 40 years, we got to get over these structural challenges, and it takes a lot of chopping to be able to do that. We probably had a little bit of a free lunch during the pandemic that is going to revert to the mean right now. So I'm sorry for being overly pessimistic this early in the morning.
Your comments were well received. Questions?
Hey, Dan.
Yes.
Dan, I have a question. John Anarella. First of all, thank you for your presentation. You know, we're starting to get some results from various primaries, and you know, one of the big takeaways is, or one of the big questions is, you know, how influential Trump is during these primaries and with mixed results. What are you kind of seeing and hearing and feeling about, you know, at least the initial primaries?
Yeah, like everything Trump does, it's complicated, right? Trump is an extremely influential person in Republican politics right now. And if not, he wouldn't have been able to pull J.D. Vance out of the, you know, from the bottom of the pack and put him in Ohio. and he could move the needle. What he's not is determinative of the result, right? So that's sort of my big takeaway from this, is that Trump could make a really big impact on the margin, but he's not going to be the ultimate determinative. We spent a lot of time trying to understand what was going on in Georgia over the last couple of months. It was a total waste of time because Kemp won by 50 points last night or something. Is that if you look at what's going on in Georgia right now, is that what you're seeing is that even people who supported Senator Perdue against Kemp and maybe align with Trump were like, we want to win. Kemp's going to win the primary. Let's be unified. And that's a lesson from the 2020 election, where Georgia was the deciding state that gave the Democrats control of both seats. So that's kind of how I see the Republicans playing out, where they'll say, hey, listen, we'll listen to Trump. We're just not going to get engaged in his personal fights over the 2020 election. And I do think that the Republicans are starting to move past some of the 2020 election issues. And I'll just give you one example. Voting was tightened up in a lot of these states. And as long as you keep early voting, you're going to have record turnout. And you're getting these huge turnout numbers in the primaries. And that tells us that when you have a month to find your voters, it's pretty much easier to do. And so that's what I see what's happening on the Republican side. Now that we're actually have voting, we're starting to see the Democratic base come alive a little bit. So midterm elections are generally defined by the party out of power gets really motivated because they don't like what the party in power is doing. The party in power, their voters are like, oh, I expected so much more. I can't defend inflation. And they get just demoralized. So the Democrats have been demoralized for like a year. And now what's happening is you're starting to see the Democrats begin to come out now that you have a choice. And so that gap is starting to narrow a little bit from some of these primaries. And I think that's something that you can maybe see in the data in Pennsylvania once we figure out who the Pennsylvania winner is. But overall, it's been a mixed bag for the president. Now I'm going to leave here and the president's going to come out and put out a statement telling you he's 104 or 106 and 5 in his primary picks. That's a classic Trump number, being 106 and 5. Okay. On the ones that matter, he's won some. He was won some in a very contrarian way, but he lost big in Georgia yesterday. Not only did he lose the challenge of a sitting governor, but the Secretary of State also won last night, who Trump made it his mission to get him out. So that's why I say it's a mixed bag. It also is going to depend on what state you're in.
So you mentioned the price, obviously being the big thing for the voters on it. Where do you see relative to energizing? Where does the Roe v. Wade stuff rank in with awesome voters? And what does that do with that? Is that energizing the one side of the base? And what is it?
Awesome question. So let me just start from I grew up in New Jersey. There's 1 million more Democrats in New Jersey than there are Republicans. In the November gubernatorial election, the Republicans had a pretty bad candidate. He's actually not like a nice person. And he almost beat a sitting governor. Okay, so it was like 75,000 vote difference with 1 million more Democrats. So that was a 13-point swing to the Republicans. You look at Virginia, Glenn Youngkin, 12-point swing to the Republicans, right? So you look at voter identification, 13-point swing. So I have all this data telling me that the political environment has moved 13 points to the Republicans. Here's where Roe versus Wade comes in. If the Republicans can start winning Biden plus 13 congressional districts, that's no longer the case, because Roe versus Wade gets increasingly more important in more Democratic districts that you get. Okay, so where we see the polling data right now is that the Republicans are doing well in all Biden plus 8 districts or below. Okay, so that and I missed my report this morning just because I was writing about politics, and probably not a good day to be writing about politics. But we showed a chart that the number of people who consider abortion to be the top issue went from 5% to 11% the last 30 days since the Roe versus Wade. And so, right, so that's a big jump. It's the only category that increased in May. Most of them are 3%, 4%, but inflation is 38% and nowhere even close to it, and increased in the month of May. So that's why I think things like abortion on the margin will make a difference in certain districts. That's in the House races. Abortion makes a huge difference in the Senate races, because now you're trying to get an election statewide, and really will become a state level issue if that Supreme Court decision stays anywhere near the way it was developed within the league. So that's over time. for example, we thought that the governor of New York was somewhat vulnerable this cycle. It reminds us a lot of 94 when a little known assemblyman from Poughkeepsie named George Pataki beat Mario Cuomo, right? Now you have like a temporary governor and this kind of lethargic. Roe versus Wade is probably going to make sure that the Democrats keep that seat, okay? And so that's how it matters, okay? But clearly, the odds of the Republicans taking the Senate have come down since that decision's come out, and you're starting to see some of these primary results. And so let's just say Ducey in Arizona got in the race, governor of Arizona, you know, he'd probably win Arizona. And Sununu would definitely win the New Hampshire Senate race, right? And I shouldn't say definitely, but very likely that they would. There's your Republican Senate right there. It doesn't really matter what happens in some of these other states, okay? But now, you know, the Republicans thought that they were going to have a good shot in Colorado. Bennett didn't win by a lot in 2016, even though Trump got wiped out in that state, right? So he looked vulnerable. It's a clear pro-choice state. It's probably going to be harder for the Republicans to win Colorado as some sort of cushion. Or, you know, like the New Jersey example I gave you, probably wouldn't be as close in New Jersey as it was last November before that. Sorry for the long-winded answer on that.
Was Sununu out and now he's out, now he's back in the Senate race?
No, he's not in. He wants to be president. So Ducey wants to be president. Sununu wants to be president. Sununu is crushing Biden in head-to-head numbers in New Hampshire. So nobody probably outside New Hampshire.
Said Sununu, and that gives you the Senate right there.
Oh yeah, if he got in. If he got in the Senate race, yeah.
But in this year?
If he got in this year, but he chose not to get in the race.
Oh.
Yeah, so my point is if Ducey,
Okay.
if Ducey stood up,
Not in.
he's not in now. If he got in, I would be much more comfortable here saying I think the Republicans would win.
Game over.
Game over, yeah.
I'm sorry.
Right, but like he's got polling data showing that he's beaten Biden in New Hampshire 55-35. So that automatically gives him a ticket into the presidential race because New Hampshire's an early state and he could win, right? So that's his thinking. I don't know what Ducey's thinking.
Okay. More homework for you,
Please.
but what was the score again? 108-4?
Yeah, 106 to 5, or he'll have some number.
So, you know, the devil's in the details.
Yep.
I would challenge you to go back and look at just on the head-to-head races what the scorecard says.
Yep.
Because we know from examples in North Carolina, a lot of that running up the score was where you had 6 people on the ballot, not 2 people on the ballot,
Exactly.
where you had a Trump endorsed person and a non-Trump endorsed person.
Correct.
I would look at head-to-head score.
Yep.
Where you had no more than 3 people on the ballot, and that score goes like this.
Mm-hmm. Yep. Very insightful.
Yeah, so
Very insightful. That's a great recommendation.
because we just experienced this in North Carolina. Getting back to your outlook and potential, obviously you weren't here for our full presentation, but what thoughts, based on what you know about our plan, given what you're saying the future might look like, what general thoughts do you have about us?
So I'm sorry I missed the whole presentation, but I'll just give you 2 data points. We had dinner with Rich Clarita, who left the Federal Reserve. He didn't tell us anything that we didn't know, but it was just the intensity of it, where I think we walked out of that dinner where we were convinced that the Fed is very worried about a 70s style inflation. You've got to get the genie back in the bottle as fast as you can. And that means that there's going to be multiple contraction on stocks. Okay, so you talk about earnings till you're blue in the face, but the multiple on stocks has to go lower. Our chief strategist put out a note 6 weeks ago, correct me if I'm wrong, and he said we're going to 3,700 on the S&P 500. The time the S&P 500 was over 4,500. Been doing this for 15 years. I've never seen our strategist get his head taken off so hard. And like, we're pretty close to 3,700 right now. Now, doesn't mean that we're always right. We're wrong. We have humility in our calls. But our view here is that we're going under multiple contraction. When you look at all the charts that I showed you the deficit has gone back to pre-COVID levels. Income is going back to pre-COVID levels. Why can't the S&P 500 go back to pre-COVID levels? You look at the major big stocks that are out there. most of them are below their pre-COVID levels. In fact, we put out a sheet in our technical report showing like there's maybe 50 of the largest companies that are already at pre-COVID levels, including Amazon, right? Like most people don't realize that. So we're just very cautious on the equity market, at least for the summer. A lot of our clients are hoping for a V-shaped recovery because that's the way we've always done it. And I think we're looking more kind of at an L or sort of U-ish. We may rally into the election. Think about 2010, big sell-off, rallied into the election. As soon as we came out of that election, it was right back to a really grinded out, tough 2011 type year. So yeah, I've known Jason, my partner, who runs our strategy part of our firm, and yeah, I've never seen him this cautious before, and I think cautious is where we are. You may miss some on the upside, but this is a tough environment to manage money in, and I do think that your model is superior to all the. We work with most of the state pension funds. You have the ability to move pretty quickly here and adjust, and we think active management is going to be a big winner in this environment rather than passive.
So you think the models or the cycle's kind of broken on the midterm data you showed, which shows the rally out of that? Or
I think we could rally into that. Yeah. I mean, those are just bear market rallies though, right? So that's why I'm like, the world's on it. Like we're going to have these fits and starts. We could rally into the election. We rallied into the 2010 election. And then we got an early year and people realized that there was a lot of consequences to what happened in the summer of 2010. The Fed did QE, Fed let off. Before you know it, we were right back in there. I think stocks were down 4% in 2011. So, that's like we got the rally, but it lasted 4 or 5 months.
One quick employment question. So unemployment levels are down, but yet you walk around any service industry, restaurant, retail, huge employment issues getting staff. What's the catalyst for change, or is there permanently not enough to support the number of businesses out there that need it? Like what's?
So we have 11 million job openings. The Fed is targeting killing out those 11 million job openings so that they don't have to kill regular jobs, right? That's what they're targeting. In practice, that's very difficult to do. And the reason why I bring that up to you is that if you look at small business income in the personal income data, it's been flat for 7 months. Okay, so that means that a small business owner's costs are going up 8% a year, okay, and their revenue is flat. So how does a small business owner correct that? They fire their existing employees to get that better. And so that's why you're going to start seeing some of the employment data begin to at least slow. We don't think it's going to go negative, but you're going to start seeing that slowing. And that's good. That means that I don't want anybody to lose their job, but you're going to start seeing the labor market begin to loosen up. And when that happens, then there will be even some less pressure on wages and other areas. But to get broad-based inflation means there's too much money in the system. As long as there's too much money in the system, you're going to still have those problems of not being able to find workers because people don't have to work if there's money floating in the system. So those issues need to get resolved, and they're going to take some time to do that. There's probably going to be some combination of job openings coming down and some people beginning to lose their jobs. But if you look at initial unemployment claims, very timely, comes out every week, starting to see them hook up a little bit, right? We're not, the decline in that is probably over. And so that means that our 3.5% unemployment rate has to go up to 4.5, and start to loosen up a little bit. What worries the economist is that once you get a 0.4% increase in the unemployment rate, or 0.5%, we've always had a recession. And if you listen to Larry Summers, what Larry Summers is arguing is that whenever we've had inflation greater than 4 with an unemployment rate lower than 4, we've always had a recession. So that's why there's these kind of 60-40 probabilities being placed on no recession versus recession, which is much higher than it was at the beginning of the year. I hope I answered your question.
Thank you.
Put another thought in your mind as homework. My mental health is hanging out with my blue collar friends who run lawnmower shops and motorcycle places.
Yes.
Plumbers.
Yep.
And in the last 3 weeks, I've had more people come up to me unsolicited and said, because of the value of my 401k, I'm going to go back to work.
Yep.
So,
Exactly.
Unsolicited.
Exactly.
So that could be a small driver in the employment crisis is what I call it in North Carolina.
Yeah, absolutely. Again, the end of free money, it's over. right? So we had free money, so you could do all these things, and you could worry about all these things. But what we're learning is once the price of money is no longer free, there's cost to staying home. There's cost to pursuing policies that, may be inconsistent with growth. At the end of the day, voters are going to demand growth. And,
Vanna did a great job. Can you go back to page 11, Vanna? If that rolls over the left chart, what do you fear?
Yeah, so let me just say, when you have higher inflation, you're going to have higher tax revenues.
Right.
And you're going to also have higher spending because the spending is built into inflation. What makes the difference is the interest cost on the debt. When interest rates go up, the interest cost on the federal debt's going to go up. And so that's why we think that you're going to start to see that roll over. What worries me.
Our non-GO DOT debt we issued last week was double what it was 60 months.
Exactly, right. Double.
Okay, so
Right, so the federal government is about to face this. What worries me is that this is fool's gold at the state level. The money is coming in. I got 30 governors up for reelection. They see inflation as the number one issue, and they're just opening up the spigots. Okay, and there's no cost right now. It's like, we can do this.
creating their own inflation.
They're crazy, right? I think the title of our report last Tuesday was states are about to make Jay Powell's job a lot harder to control inflation at the Fed. Okay, but I worked in New Jersey's governor's office on pension issues during the tech boom and the tech bust. So I got to see both sides of it. And the legislator would sit there and say, we're going to do this spending program, because it just kept happening year after year after year. The key issue is that you cannot take this money and make them permanent programs, or it will disappear on you. This is why California gets in so much trouble. They're so dependent on that capital gains revenue. What happened in 2021 was that income pulled forward into the year. There were tax increase proposals, SPACs, IPOs, mergers, all those things. People just pulled forward their income. That became taxable in April. Now we're in a bad market with a hangover from that pulling forward of income. Those numbers are going to start going down on the revenue side. And that means that you've got to be very cautious with the money that is in your budget right now. To be honest with you, what I would do is I would pay down debt or pay money into the pension systems, because you could do one-time dividends on that. That gets
Second.
that gets when I used to recommend that.
Healthcare liability.
Healthcare liability, yes. So, but when I would recommend that in meetings, I was like, I was a 25-year-old kid when this I was like, they were like, who let him in here? Get him out. It gets 0 votes for some of the elected officials. So, but that's what you should be doing. Use this as a one-time dividend to be able to shore up your balance sheets. That's the most prudent use of this income. This was a gift, and use it to the best you can. So
the good news is one of my duties is I chair the Debt Affordability Commission, and state debt of North Carolina over 8 years is going to fall 60%. In the oven. It's already done.
And how was that achieved?
Discipline, strategy. I'm reporting it to you. It's achieved on the backs of taxpayers and businesses. That's how it's achieved, through the discipline of the General Assembly. But 5 of those years are in the windshield, and the other 3 we've defeased, announced we're pre-refunding, or not going to issue. So this is not a analyst report.
Yep.
This is
Happening.
60% reduction.
Wow.
And I reached out to other states. We don't think there's anybody else in the country that's ever done this.
That's amazing.
Yeah.
That's amazing.
Another thing you can take.
May end up in a report next week. So,
Well, that's why NC stands for nothing compares.
nothing
You can
compared,
title it.
right? That's it. But like I said, this is now a race for capital amongst the 50 states. North Carolina is a leader. It's these types of things that really matter. I'll tell you that there is a very strong correlation between state unfunded liabilities and migration. And it's not like a voter in California is like, oh, I know I got, X amount of unfunded liabilities. But voters inherently know what their current and future tax liability is, and they want to be located in places that are going to treat debt capital the best. And you are a great example of that leadership. Thank you.
So I pose that other question because we have representation here from the State Employees Association, who, for most of their members, the 2 most important things behind their members' health and faith and family is the safety and security of this pension and this health.
Exactly
plan.
right.
So I hope you've given them, feel like that they're in a good situation.
Absolutely. And I would just say my father is a state employee, pension holder. So what you're doing for the retirement security workers of North Carolina, I commend you. And it's personal for me because my father relies on that pension payment every month. So thank you for your leadership for the state employees.
Any other questions? Well, we always don't know where you're off to next, but we're splurging on you today. We got gold bars and
I love it. Thank you.
but we appreciate you coming in. We appreciate the work you do, and we're, this board and other boards that I chair, we're just simply trying to figure out what's right and get it right, and we think right's rarely wrong. So you didn't hear this. We have the highest levels of cash in the 50 years in the pension.
Yeah.
And we have the shortest duration in probably over 50 years, possibly. I'm here for all that.
I know it's tough to move there. I understand it. And when we started thinking about going to cash, I was worried about that because inflation was going to erode that. And it's the actual right call to be in cash right now.
But it's a big deal. The average citizen in North Carolina is costing $5,000 more this year to live versus last year.
Yep.
So the eyes have it. Higher interest rates is an eye and higher inflation. We appreciate you coming.
Great. Thank you for having me. Appreciate it. Look forward to staying in.
Can you see them out?
Thank you, everybody.
Thank you, guys. Who's next?
He's remote.
Okay. Okay. Hey, Troy.
Hey, can you hear me?
Yeah, I feel better. Go ahead.
Thanks. Sorry I couldn't be there today. I really wish I had been or am. But
Well,
2 years
we're
of
not
dodging.
sorry you're not here today, Troy. We're glad you're not here today.
Right. 2 years of dodging and weaving, I finally got hit. Can we start on page 3 of my presentation, please? I just wanted to point out that within the last year since we last met, that we added a new person to our team, Casey High. He joined our team from the public equity team in October, and Casey's been a great addition to our team, as has Chris, who had joined our team just prior to the last IAC presentation. Next slide. Just run through these real quick. Our thoughts on the various sectors. Industrial, just insatiable demand for infill industrial real estate, which is all that we focus on here. Demand and rent growth expected to remain strong for several years. Self-storage, unprecedented demand in that sector has outstripped the high supply levels. People decluttering their homes to make home offices. Rising residential prices will continue to benefit self-storage as an alternative to buying or renting space in their homes. Multifamily, the relative affordability ratio is really favoring apartments right now. Home prices have moved up so much so fast that in comparison, multifamily is cheaper right now. We're seeing lots of capital flowing into single family rental and build to rent, specifically build to rent communities. Data centers, I got mixed feelings there. Data center vacancy is at record lows and the sector is strong, but it's a very expensive sector. Large capital requirements to build and invest in there. And so we haven't endeavored into that space. Student housing, campuses continue to operate on a mix of remote and in-person basis, but students have demonstrated a really strong desire to be on campus. Occupancy remains very high at properties where we have exposure to, and leasing has been strong there. Office is a real mixed bag. It depends on, as most of these sectors are, it just depends. It depends on where you're at. There's been a big migration from gateway to non-gateway markets. The gateway markets have really struggled, but in the last 6 months, there has been green shoots in leasing in the gateway markets. We are still starting to see people looking for space in those gateway markets. It's going to take a while, though, for that to really come back. And the gateway markets have suffered. All the non-gateway markets like Raleigh and Charlotte and Austin and Nashville, they've benefited from the flight out of these gateway markets. The Raleigh market has been very strong over the last 2 years. Senior housing, another mixed bag. There's a lot of demographic tailwinds in senior housing, but it's a very operationally intensive sector. The margins have really been hit in this sector primarily because wage inflation has cut deeply into the margins. It's very operationally intensive to have senior housing. Retail, most types of retail remain challenged and will have headwinds for years. Essential service retail, small, non-anchored, non-grocery anchored, has proven very resilient and is an attractive sector for me right now. Hotel, business travel still well below pre-pandemic levels. Leisure travel has picked up meaningfully, though, but staffing remains a challenge at all types of hotel. Next slide, please. We're right at about our target. We're just a little over 8% right now. We have a legislative cap of 10%, so we have a fair amount of headroom for our asset class to either grow or cushion in case the denominator falls. Right now we're 72% core. We're overweight our target to core. Our target's 62.5%. We're at 72.5%, but I kind of like that positioning right now. 28% non-core. We've had very strong growth in our core separate accounts in the last year or 2 years, which has pushed the value of our core holdings up meaningfully. On the right-hand side, you can see we really, we haven't changed on an absolute basis a lot over the last 5 years. It's been more the denominator that has moved our percent of plan number up and down. We've had, as you'll see later, we've had meaningful distributions from the asset class along the way. Next slide, please. Here you can see those distributions I just mentioned. We've had very strong distributions over the last 5-6 years. In the expectation for 2022 is contributions will definitely go up from the last year, from 21, but distributions are likely going to be at record highs. It could be double from where we are now. There's been strong demand to transact, pent-up demand to transact that's taken place in this year. The treasurer mentioned Cosmopolitan earlier. We haven't received that distribution yet, I don't think, at least. If we have, it's just been the last couple of days, but I think that's coming in the next couple of weeks. Blackstone also sent us a lot of money back. They recently sold all their European industrial, and they sent us back $120 million back from that transaction. With Cosmopolitan, it'll be closer to 100. So we've been getting big chunks of money back from all of our managers in 2021 and 2022 thus far. Next slide, please. We continue to push into more and more exposure, greater levels of exposure with fewer managers, or high conviction managers, as we call it, or our separate account managers. This provides us better alignment of interest, lower fees, and provides for greater control of our portfolio, which is really maybe the most important thing that we're focused on, is trying to give ourselves more control of asset allocation decisions, because research has shown that asset allocation decisions drive 90% of your total return. So we want to be able to control those decisions more than as if we were in a portfolio of commingled closed-end funds. Next slide, please. Cost efficiency. Fees remain low and continue to decline. The chart on the left shows that fees ticked up slightly, but this chart represents fees as a percent of market value, and market value had taken a dip as of 12/31/20. Next year, when we show this slide, fees should show their continued downward trend. At some point soon, this is going to bottom out. You can only push it down so far without just going purely passive, and that's not our goal. This downward trend over the last 10 years is a direct result of us moving more and more of our exposure into separate accounts and away from closed-end commingled funds. Holding high-quality assets longer term rather than churning them reduces a lot of friction costs, particularly fees on committed but uninvested capital during the initial investment period. Next slide, please. This is a great chart. It shows the real estate portfolio has been doing exactly what we want it to, producing consistent returns. Our return expectations for the recent asset liability study are 6.3% for core and 8% for non-core. Over the last 10 years, we've produced over 10% returns on the real estate portfolio. I think's great, especially considering we are 72% core and just 45% leveraged overall, including core and non-core in our portfolio. The 10-year performance is great on an absolute basis, but especially on a risk-adjusted basis. One important key to consistent returns is building a diverse portfolio. Diversity comes in many forms: sector diversity, geography, vintage year, to name a few. I read something recently that said if your whole portfolio is doing great all at the same time, you aren't diversified at all. Our portfolio is well diversified. It produces resilient, consistent cash flow, and it's well positioned to withstand whatever may come in the future. I have strong conviction that the next 10 years will be even better than the last 10 years, given our focus moving into more and more exposure to our separate accounts and high conviction managers. Next slide, please. Core performance was under our benchmark, and that's primarily due, we had a significant underweight to industrial, was a primary detractor to performance for core versus our benchmark. Industrial in the Odyssey benchmark in the 1 year period had returns greater than 40%. And we are underweight industrial by 500 to 600 basis points. This has been a problem for us for years. We've been chasing the neutral weighting for years. 5 years ago, we were 13% industrial and the benchmark was 17%. Today, we are just under 20% industrial, but the benchmark has moved up to over 25%. And I just saw numbers this morning that showed, for this is as of 3/31, the performance numbers, but later in the presentation, we show sector weightings, and that was as of 3Q21. But the 4Q21 numbers, industrial in the benchmark has moved up to 27.7%. We were at 19.7%. So we've just been chasing this by the tremendous growth of industrial, even though we've been growing. But I expect this gap to narrow some over the next 18 months. We made a commitment to our industrial separate account manager in fourth quarter, and as they deploy that money, that's going to help us close the gap. And as we have more and more exposure in our separate account, that money's not, they're not selling assets. Our problem is folks like Blackstone, they build up these portfolios, they do great on them, but then they sell them and send money back to us, which is good, but it's been a persistent problem because we've been continuing to get money back. But as our industrial separate account grows, that gap will narrow in the next 18 months. And Odyssey, they can't grow their exposure to industrial to the sky. At some point, that's going to have to top out, and the industrial, the Odyssey funds, their industrial exposure the growth of that will slow at some point. Next slide, please. Last year, on the bottom of this slide, we noted that this year or next year, from last year's perspective, would be better, and it certainly was. 1Q valuations continue to come in with meaningful appreciation compared to 4Q 21. Our performance was great considering we're underweight industrial in our non-core portfolio by 500 to 600 basis points compared to the benchmark. This underweight to office and overweight to residential helped offset our underweight to industrial in our non-core portfolio. Next slide, please. This shows our unfunded commitment pacing by vintage year. And one thing to point out here is fees. Fees on unfunded commitment are a big drag on performance. Something that we've been working really hard over many years is to minimize this. Minimizing this has been a focus of ours. Of the $1.4 billion in unfunded commitments for our asset class, right now only about $250 million of those have fees on committed but uninvested capital. That would be our most recent commitment of $200 million to TPG, and a small amount of the original $300 million commitment to Blackstone in 2019, which you can see in the gray bar across the bottom there. The $482 million of commitments in 2020, those were to investments that do not have fees on uninvested capital at all. So no J curve there on that 482, and that's been a big focus of ours is thinking about how can we get money deployed without paying fees on committed but uninvested capital. Sometimes, it's unavoidable. We want to be in funds like Blackstone. Blackstone, by the way, on that $300 million commitment that we made in 2019, they're crushing it. Their returns are greater than 40% thus far on that fund. So, we want to be with the very, very best managers like Blackstone. We believe TPG is going to fall into that category, which is why we're willing to pay that freight in that particular case. But moving forward, we're really focused on that. When we make commitments in our separate accounts or let our separate accounts grow, there's no fees on committed but uninvested capital. Next slide, please. We want to do something a little different. Excuse me. This year, because we've got a great program that we wanted to talk about a little bit, and we wanted to share a case study of one of our Build the Core programs. Next slide, please. In 2016, we launched Rockwood Development Partners and since invested approximately $220 million into two large-scale, long-term mixed-use development projects. Today, those two projects are marked at about $390 million of net asset value. The thesis for this fund was to develop large mixed-use properties located near transit or future transit so that our investment benefit from the significant investment by state and local governments into transit infrastructure. And Ivy Station is one such mixed-use development project that I wanted to highlight here. It's in the West Los Angeles submarket of Culver City, and you can see it here. It's right on the Expo line. The Expo line runs from Santa Monica down into downtown LA, and our project is right at a transit stop in Culver City. This project includes Class A office, retail, apartments, and hotel totaling about 577,000 square feet. When we bought the site, it was a surface parking lot that people used to park for the Expo line. Today, there's 1,500 underground parking spots to serve 244,000 square feet of office, 45,000 square feet of retail, 200 apartments, and a 148-room boutique hotel, as well as 300 spots specifically designated for transient expo train line users. A key feature of the site underpinning the investment thesis is that it sits directly adjacent to the expo line. The line carries 60,000 commuters every weekday. Next slide, please. Just a visual so that you can see the ocean in the distance here. Culver City is considered part of the technology and media-driven employment hub known as Silicon Beach. It shares a border with Playa Vista and Marina del Rey submarkets, which are considered some of the strongest office submarkets on the West Coast. Next slide, please. This is schematic, I guess you might call it, but you can see the HBO, the office building at the top of this slide. 100% of Ivy Station's office has been leased to HBO for 15 years. 81% of the 45,000 square feet of available retail is currently leased or under LOIs. Stabilization expected to occur in by first quarter of 2023. The 200-unit apartment complex is now 90% leased ahead of underwriting. The Shea Hotel has 148 rooms, as mentioned, and opened in October. 78% occupancy in March of 2022. Occupancy and ADR both ahead of underwriting. This has been a fantastic project for us, and it's just a great example of the kind of product that we want to own long term. Next slide, please. This is a good actual picture of the project. In the foreground, you'll see the boutique hotel. In kind of the middle are all the apartments, and then towards the back of the property, you see the little red spot to the left. That's across there, the HBO building. Since inception, this project, Ivy Station, has produced just under 19% IRR and a 1.x equity multiple since inception in 2016 of this fund. It's a great example of the iconic investments that we want to own long term. The synergies of mixed use and the location right at the transit stop will make this a fantastic long-term, resilient cash flow producing asset. Just the kind of thing we want to hold. As good as Ivy Station is, I believe our next project in this development platform will be even better. We acquired a site in Bellevue, Washington, which is just 10 miles east of Seattle. I don't have a slide on this. I'm just talking through this, which is just 10 miles east of Seattle, with a long-term business plan to build an urban transit-oriented mixed-use community with a similar investment thesis to Ivy Station, which is to locate it near and benefit from significant public infrastructure investment in transit. Bellevue is an extremely fast-growing submarket of Seattle, and the city is undergoing a rezoning effort to increase density and allow a more diverse mix of uses. A much-needed light rail system extension through Bellevue, connecting Seattle, Mercer Island, Bellevue, and Redmond has been fully funded and should be operating by 2023. This light rail line goes right past our site with a stop 1 block away. The office market in Bellevue is largely occupied by the FANG companies, all of which have grown incredibly in this submarket in the last 3 years, and all have expressed interest to add significant employee count to the area. There's also a meaningful shortage of housing in this area to support the significant job growth. So this project will include a lot of residential development in addition to the office to take advantage of the supply-demand imbalances. The entitlement and permitting process is likely going to proceed through 2023, with construction slated to start in 2024. And I look forward to presenting updates on this investment as it progresses through the rezoning entitlement process. Next slide, please.
Troy,
Go ahead.
I think you did a good job of recapping on the upcoming slides through the approach and stuff. I think we wanted to try and stay on the timeline here. Just a couple of things you want to highlight that are different than maybe in the past, or anything new You want to cover real quick would be great.
You know, that's what I was going to say. Nothing's really changed here. We've been pretty consistent for the last several years about our investment strategy objectives, and we're continuing to move in the right direction. And really, nothing has changed. We're continued to focus on our separate accounts and reducing our manager accounts, yada yada. So no, nothing's really changed. I think our portfolio is in great shape. It's well positioned to weather, you know, whatever may come in the next couple of years. If we fear for recession or inflation, we're well positioned, I think, to weather that. And that really kind of concludes my presentation.
Any questions? Thank you, Troy. We appreciate your participating and hope you get well soon.
Thank you.
We're going to have a short presentation from Ben regarding our code of ethics, and then we'll go into our IEC member questions and then public comments.
All right. Thank you, Treasurer. So this is directed to the IEC members. We review the IEC Code of Ethics annually. I'll just highlight a few of the key components. First, under Section 3, there's a section that talks about that certain transactions are restricted, transactions between IEC members, interested parties, and the retirement systems. And I'm not going to review the entire policy. It's been sent to you already. I'm just going to hit highlights. So first, there's a transaction restriction. Second, discussed in Section 4, there's a recusal requirement when a particular matter is being evaluated. And I'll touch on some updates that we've made to the Code of Ethics related to Section 4 in just a moment. Third thing to note in Section 6 is the confidentiality requirement in the IEC Code of Ethics. And then the fourth thing I wanted to mention is that in Section 8, there is a required disclosure of conflicts of interest and Code of Ethics violations if IEC member becomes aware of them. A couple changes to note. I think I emailed all the IEC members yesterday. We had a policy, the Code of Ethics was updated recently back in March. Really two key changes. One of and the changes were all relatively minor, but the prior version of the Code of Ethics discussed voting on transactions. And since that's not really a function of the Investment Advisory Committee, we took that out and instead replaced that language with advising instead of voting. And then second, we just tried to simplify the annual acknowledgement form just to make it a little bit easier to understand and to do. That's a quick, very, very quick overview. All the IEC members have been emailed. Following this meeting, staff will work with you to get the annual acknowledgement form signed and returned to us so it can be on file. Any questions about the Code of Ethics that was sent to you, or any questions about its requirements, changes, etc.? Okay, thank you. The very next thing I'll talk about very quickly is also something we do annually is highlight some of the IMD policies. If you'll go to the next slide. So it might be hard to see, but it's in your materials. So these are this is a list of the key policies that govern the functions of the investment management division. These policies are reviewed annually or every other year. So there's a regular, consistent look at these policies to make sure that policy and practice are still aligned. In particular, a couple of key updates. Chris Morris already went over the changes to the investment policy statement. That's really the key backbone type policy for the investment management division. A couple other policies that have been changed or updated. One of those is the investment manager vehicle selection policy. That's Chris Morris really led the charge on that. There were two policies, one governing internal management and one governing external management. That's been consolidated and clarified. And then the last thing I'll mention is an update to the divestment and contract prohibition policy. Up to this point, until recently, we had 3 statutes in North Carolina governing that provides divestment restrictions. Those were restrictions related to investments in Sudan, investments related to Iran, and then also investments in companies boycotting Israel. Last year, the statutes related to Sudan were repealed, so we removed that from the policy, leaving just the statutes related to investments in Iran and also companies boycotting Israel. Again, all the policies are reviewed regularly, and we make changes from time to time. But any questions about any of our policies or any of that, what I've just said from IC members? Okay, well, thanks for that. I wanted to be very quick on that. It's important that we do that review annually, but also don't want to belabor it. So, I'm done.
Thank you, Ben. And I think Laura probably helped you with some of this.
Laura is a main driver of making sure these get done and done well. Laura, our compliance officer.
Thank you, Laura. A little bit ahead of schedule, just want to go to IAC members to see if they have any comments, then we'll go into the public comment section.
No, sir, no additional comments.
Mayor?
No, I'm good. Thank you.
Thank you. Mike's on mute, so he just texted me. So thank you all very much. We'll now go to our public comment section. We have several people signed up for public comment. Want to read the rules or have you already?
I haven't read the rules. There's 3 minutes.
Are they on? Yeah. Okay, good. Rules. Public comment.
Public comment, it's a period of open comment. You'll have 3 minutes to speak, and then I'll keep time, and then we'll move on to the next person.
Okay. With that, we'll start with Angela Bonfiglio. Angela, are you with us?
Hi, yes, I'm here.
Right. And say the name of your organization. You have the floor.
Good morning, board members and staff. Thank you for your time today. My name is Angela Bonfiglio. I'm an organizer with Renters United for Justice. I'm here today because in 2018, the North Carolina retirement systems committed over $1 billion to Landmark Partners. And before that, it committed $6 million. This makes North Carolina by far the largest pension fund invested in Landmark. Landmark is now owned by Ares Management, which acquired rental home company Front Yard Residential and Havenbrook Homes in a joint venture with Pretty & Partners, the country's second largest owner of single-family rental homes. Front Yard and Havenbrook directly owns and rents hundreds of single-family homes in North Minneapolis, which is largely comprised of low-income people of color. After organizers and tenants commented at the Minnesota State Board of Investors meeting in December 2021, Ares Landmark representative Frank Borges agreed to work with the tenants to address the issues mentioned before the next MSBI meeting in February 2022. Since that December meeting, Renters United met with Ares Landmark and Pretty & Partners a few times to identify clear ways the parent companies of Havenbrook could fix the issues and create better communication between tenants and the company. On February 10th, the Attorney General of Minnesota, Keith Ellison, announced that his office had filed a lawsuit against Havenbrook, the parent company which owns more than 600 single-family residential properties in Minnesota, due to its failure to maintain the rental homes. Although some of the renters' complaints have been addressed, there are still major outstanding maintenance issues as well as poor communication. Additionally, in cases where the company is trying to make repairs, there are many examples of poor quality repairs made, creating further damage or requiring additional repairs. These outstanding issues have required renters in Havenbrook to take steps themselves to get their needs addressed. Since February, 7 renters living in Havenbrook homes have sued their landlord for a myriad of issues, including long-standing repairs that have persisted for years. These include major structural issues, doors not working properly, significant mold issues, broken windows, significant water leaks, and mice and rat holes. Trustees, on behalf of hundreds of tenants in Minnesota, we are asking you to please reconsider investing in Ares until they adequately address the living conditions of the tens of thousands of single-family homes it owns and rents to low-income families nationwide and in Minnesota. Thank you for your time. I've also submitted my full statement for you to review. Thank you.
Thank you for joining us, Angela. Mr. David Green. Mr. Green? All right. Our next is Jessica Marino with Action NC.
I'm
Jessica, are you
sorry,
with us?
I couldn't get my mic to work. I've got it.
David, you have the floor.
Thank you. My name is David Green. I recently retired from teaching and coaching after 49 years. The last 22 of those in the state of North Carolina. I would like to address the retirement problems caused by lack of pay raises for those teachers with the most experience, who, of course, are the ones that are most likely to retire. If we go back to 2013, 2014 pay scale for teachers, the top steps on the pay scale were paid $54,780 by the state. The next year, 2014-15, the pay scale was changed with the top of the scale being $50,000. And along with that, longevity pay was eliminated. So if you were in the system in 2013, 2014, you will continue to be paid at that $54,780 amount every year since then, because the General Assembly passed a hold harmless provision each year after that. Without that hold harmless provision, your salary would have dropped to $50,000 in 2014-15. It would have only increased to $52,680 by the current year. Okay. And as I said, longevity pay was also removed. So you have a large group of teachers, those who are retiring now and over the past few years and over the next few years, who are kind of stuck at the same pay from the state for almost a decade. So given that retirement is based on the income from your years with the highest salary, your highest years are stuck at $54,780. Working more years would not increase your retirement income as one would normally expect. That's even more the case with the removal of longevity pay. That then is the issue for anyone who has retired over the past several years. Their retirement income is not what it should have been due to the General Assembly's failure to give them pay raises that would have put them above where they were nearly a decade ago. For many teachers who have had to work a second job while teaching in order to make ends meet, they will continue to have to work after they retire due to a retirement benefit that is lower than what it should have been. Now, I'm not here to argue for my own benefit. I've been fortunate enough to work in Wake County, a district that's done its best to provide local supplements that are among the very best in the state, and that has provided raises for its teachers. I actually left Wake for a few years to teach and coach in another district, but after 2014-15 changes to teacher pay, I moved back to Wake in order to be able to be sure I could support my family. Not everyone has that opportunity to just go to a high-paying county. I was able to do so because I was a fairly successful football coach who could land a job there. Most teachers in the state don't get paid that same level of local supplements that I receive. Many get no local supplement whatsoever.
Mr. Green?
Yes.
Mr. Green?
Yes.
Your time has expired. We've all listened intently and appreciate your service. Can you sort of get some closure?
Yes. Basically, there's no need to cry over what's gone on in the past with teacher pay, but there needs to be some help for retirees who are stuck there. The answer is cost of living increases, and in order to be able to afford cost of living increases, it's important that the fund doesn't just sit on cash that it could be investing, that this money is invested so that there can be some money to pay for cost of living increases. Thank you very much.
Thank you. Our next presenter is Jessica from Action NC. Jessica's not with us. We'll now go to Artis Watkins or Suzanne, who are joining us in person. Thank you for coming. The
President of the State Employees
Hi.
Association.
Hello, this is Jessica. I was just unmuted. I wasn't able to unmute before.
All right,
Can I start?
Yeah, you have 3 minutes. Thank you.
Good morning. My name is Jessica Moreno. Thank you for the opportunity to testify today. I'm an organizer with Action NC. Our mission is to win greater racial, gender, economic justice through popular education, grassroots organizing, mobilization, leadership development, and increased voter participation. Action NC is an affiliate of the Center for Popular Democracy, a national network of grassroots organizations. We are leaders of Renters Rising, a national association of renters who live in corporate-owned properties. Renters Rising is organizing to transform the unequal housing system in our country so everyone has a home to thrive. In Charlotte, North Carolina, 1 in 9 tenants live in corporate-owned housing. We've been organizing and talking to tenants that live in these properties, and we see the same trend: increased eviction rates, reduced conditions and services, and increased rents. In 2018, the NC retirement system committed $1.25 billion to Landmark Partners, and before that, it committed $600 million. This makes NC by far the largest pension fund invested in Landmark, which is invested in Pretium Partners in Progress Residential, the second largest owner of single-family rental homes in the U.S. A recent investigation by the Charlotte Observer found that the business model for Progress Residential and other institutional investors is finely tuned to squeeze profit out of their homes, often to the detriment of renters, neighbors, and other would-be home buyers. The Observer detailed horror stories such as one Progress Residential tenant who told Progress that brown water was oozing out of the faucet and toilets. Progress didn't do anything. And then in addition to the continued plumbing problems inside the house, sewage began rising in the backyard. And the company didn't fix the problem until the tenant complained to the Attorney General. I speak with tenants across NC who live in Progress properties, and every year the rent is going up. It's hard to reach the management company. The regular maintenance or minor repairs are on the tenant's responsibility. So tenants feel stuck in a market where there aren't enough options for affordable housing. Lease renewals bring rent increases of $100 to $150 a month. If the tenants choose to stay on month-to-month leases, the rent goes up $200 to $300. Corporate landlords are buying up all the housing, so rather than becoming homeowners, tenants are forced to continue to rent because of the lack of options. Housing is political. There's no way you can stay out of it if you're literally funding displacement and homelessness. Your loyalty is to your members, but remember that with power comes great responsibility. The negative effects these companies have on the real estate industry will have long and short-term effects on everyone, including your members. We ask that before you invest any more money in Landmark Partners, you investigate the negative impact that the company is having on the people of North Carolina and hold them accountable to treating renters like humans. Once again, I thank you for the opportunity to share my experiences, and I look forward to seeing what actions you all take in the near future.
Thank you for joining us, Jessica. And next, our presenter is Artis Watkins from the State Employees Association of North Carolina.
Okay. Well, thank y'all for having us here today. My name is Artis Watkins. I'm Executive Director of the State Employees Association of North Carolina. We have about 46,000 members, active and retired public employees, state employees. And so over the years, we have paid more and more attention to what the Board of Trustees does, because we're always looking for a COLA for retirees who spent their career serving the public and are looking for their check not to stay the same in retirement. But that board, they make recommendations to the General Assembly, but the work of this committee is integral to whether or not the funds are there for the board to actually work with in terms of a recommendation. We have appreciated the efforts of Treasurer Falwell in a number of areas, but one is the continuation of a consistent, I heard you say consistent earlier, and I thought that's the name of the game. The consistency here with our investments has kept North Carolina in the situation we've long been in. Our asset to liability ratio has been the envy of the country for a very long time. But we also knew we were paying investment fees that seemed to be getting out of check for a while. I appreciate the treasurer's commitment to try and stay on top of that and make sure we're not wasting any of the taxpayers or the state employees' funds by paying excessive fees. We're also aware of what's coming. You know, the silver tsunami, the baby boomer dilemma, as one documentary called it last year. However you want to phrase it, we're aware that we're getting ready to have so many more people who have left the workplace, who have finished their service to the state, than are currently in it. It's going to require not just the continued consistent approach, but not swinging for the fences. Sometimes I hear other groups suggesting that maybe we should do things that are even riskier with our investments. State Employees Association of North Carolina and our retiree council that specifically addresses these issues is absolutely against swinging for the fences in any kind of way with these funds. We really understand the difference, that we're not an endowment. You know, we're not a private investor. This is retirement for individuals. So again, we want to say thank you to the committee, mainly thank you to Treasurer Falwell for his consistent, diligent approach to how these funds are managed, and to a commitment to try to make sure Wall Street isn't taking anything unnecessarily out of the pockets of folks that are here in North Carolina. So thank you.
Very much. Appreciate our partnership. And our last speaker, we'll close our public comment section, is from Jack Cozart, or his representative from the Retired Government Employees Association. Can you hear us, Jessica or Jack? They can hear us? No. Okay. Okay. Maybe we'll come back at the next IAC meeting. Members will hereby deem our public comment section closed. We would appreciate Ted, Chief of Staff, filling in for a few minutes as we crank the meeting up on time. We will adjourn our meeting in honor of all those families and the communities that will be forever affected by the tragedies in Texas yesterday. And with that, I'll entertain a motion to adjourn.
So moved.
I'll second.
Second. Okay. Thank you. Any further discussion? Hearing none, all those in favor say aye.
Aye. Aye.
And I want to thank staff and everybody for putting this together, and all the behind the scenes folks who work in the investment management division. And every opportunity I get when we talk about the reduction of Wall Street fees, I always push the power and credit down to the partnership we have with the investment management division. And with that, did Jessica or Jack join us?
Jack Cozart is here.
No, Jack, we've been waiting. I'm sorry. We're getting ready to adjourn. Go ahead. You have 3 minutes. Thank you.
Thank you. Thank you, Treasurer and members of the advisory committee. I'm Jack Cozart. I represent the North Carolina Retired Governmental Employees Association. We have 66,000 members, and we represent over 300,000 state and local government retirees. So we are vitally interested in the work of the Treasurer's Office and this group. Very important to us as it funds both the pension plan and the health benefits for retirees. We are pleased that through the good work of the Treasurer and this group, North Carolina has one of the best funded and best managed pension plans and retiree state health plans in the country, if not the world. And I just wanted to express our appreciation on behalf of the association for the good work that they do in managing this fund, in handling the state funds, and doing the great things that they do for the benefit of state and local government retirees. Thank you.
Thank you, Jack. And probably gave Laura gray hair too, as we were adjourning, and I put public comment back up there. But I appreciate the technology and your comments very much. So we have a motion on the floor in a second, no further discussion, and all those in favor have said aye.
Let me call them. So, can I get the second? Who seconded?
John.
John Innerell. Okay. Let me just call the roll then. So, Mr. Brewer? It's for the motion to adjourn. So, motion for Mr. Patterson, a second for Mr. Anarella. Mr. Brewer, are you still on the line? All right. Mr. Mevin?
You had to sign off.
But then he had to sign off. Okay.
So am I stuck here all day now?
Force lunch in? I got it. Ayes have it. Thank you. We're adjourned.